So putting in there, where are you joining us from? Canada is big, So where part of Canada are you joining us from? So we just have some time. Just give us more 5 minutes, then we're gonna start. The guest speaker is already here. Oh, what happened? The guest speaker is already here to give us so okay. So just 5 more minutes and we're gonna start. We want to thank everybody for joining us today. From anywhere you're joining us from in Canada, we can see Montreal. We can put a shout out to some people. We can see you, Wuzo, Edmonton. Thank you, iPhone. We don't know your name. Branson, Debs, Edmonton, Bramatu, St. Catherine. St. Catherine is in Ontario, I guess, right? Omoni, Niagara Fall. I hope you go to see the water all the time. Thank you guys for joining in. And we have other people that didn't give us that where they are joining us from. Grace, Ade, Nichi, Aduremi, Altai. Anybody, Fuluki Adebayo, thank you for joining us. Fuluki from Winnipeg, Manitoba, Big Dream, Montreal, Rabia to Gatineau, that's where we stay. If I didn't mention you, maybe because I didn't see you. Casey, Grace, Adeni, Juwon, Brampton, Ontario. Thank you for joining. Everybody, if I see your name, I'm going to mention it because we still have some time, but we are still waiting for other people to join in. Casey, Oshawa, Ontario. Thank you, guys. Oyinda Mola, you have Sydney, Nova Scotia. Oh, wow. That's good. I hope you guys have not started seeing a lot of snow.
I said, let me see this. Maybe I can buy. Is it just leggings?
Please mute yourself. Please, just mute yourself. I know you're on the market or in the mall.
It's line one, so it's warm. Is it for warm weather? Yeah, for cold weather. All right, come down. We are down here.
So Oluwatobi Filani is from Cambridge, Ontario. Thank you guys. Wow, everywhere from Canada. That's interesting. So wow, we have a lot of people on this call. Thank you guys for joining in. Um, thank you guys, everybody for joining in. So 3 more minutes, then we're gonna start. And we're going to hand over to our guest speaker that are going to do justice. Yeah, a lot of people might be thinking, why are we here today? Basically, what do you stand to gain from this webinar? I bet you this is a lot of information. Well, we got to know about this information early, and thank God to the guest speaker that gave us an idea of what we needed to do on time. And that really changed the that really changed our story a lot, basically. So getting a mortgage is not only when you're ready. Mortgage preparation must start even 2 years or even a year before, before you decide to buy a mortgage. So a lot of people think, oh, I want to buy a mortgage, I have to wait 6 months before. No, sometimes it might be like 2 years, sometimes it might be like a year, you start planning to get a mortgage. Aduremi, Abiodo, thank you. This is from Toronto, Ontario. Thank you so much, you guys, oh God, thank you for everybody joining us today. So basically, I have
Where's the tie?
to join.
So you wear extras?
And we're gonna start.
Okay. Mm. So is it that you wear it before you wear any other thing? Okay. Okay. Okay, where is it? Okay.
Mm. You will join meeting. Please. Okay, so uh, 2 more minutes, then we're going to start. Please, if you're just joining, please, I've already muted everyone. Nafisa, thank you. Please mute everyone. Yes, I've done that already. So if you're just joining, please, just where are you joining us from? Thank you so much, and for joining. A lot of people from everywhere in Canada, we can see that, right? So thank you so much for joining today. I know it's a Saturday, this is a time maybe some people are even at work or probably at home trying to take a nap, trying to rest, but it's something very important that you must, this information that we want to pass is also very, very key. Abby from Sydney, Nova Scotia. Wow, that's who's all too? You're from Nova Scotia. That's good. I hope you guys have not seen a lot of snow. Um, So let's give 2 more minutes, then we'll start. Oh, no. Okay. 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 So, okay, let's start. So, okay, so I'm the host today, and basically, so my name is Adeshola Nyola. So little introduction about myself. I'm a skilled accountant, bookkeeper, trust professional, and I'm also a financial advisor with a wealth of experience in providing comprehensive financial solutions for individuals and businesses. So as a co-founder of Young Boss Tax and Accounting Services Incorporated, I've already built a lot of reputation for delivering exceptional services for fostering long-time client relationship through expertise, transparency, and reliability. So basically what we do more budget, investment planning, work growth, and we empower clients to achieve their short-time and long-term financial goal, from small business seeking operational efficiency to individual managing personal finances. So that's what we do. So we provide guidance that provides financial success. So with a strong foundation in accounting and bookkeeping, additionally excel in helping clients maintain accurate financial records, ensuring compliance with regulatory standard and optimizing business operation. Their in-depth knowledge of tax law and strategies enables clients to minimize liability while maximizing return, making tax season seasons stress-free and efficient. Uh, so these are services. So we income tax preparation. So right now we are going to tax season. A lot of people are start planning, I'm going to do my taxes and all that. So tax planning starts now. So we help you to do that. Filing self-employed individuals, corporate tax returns preparation, partnerships, sole proprietor tax return, business deduction, and credit identification, GST filing. So for bookkeeping, we do all that, record keeping, financial statement, by reconciliation, whatever thing that you needed as an accountant, we help you to provide that. So this is our guest speaker. My guest speaker is a wonderful, wonderful man, a wonderful man. We've been friends now over 5 years now. And this is somebody that you can run to and is ready to help all the time. So Gomez is a dynamic leader with extensive experts in business operation, logistics, and advocacy. With 15 years of experience managing his family dry cleaning franchise, he owns skill in franchise governance, contract, negotiation, and corporate structure. In 2017, Gomas founded the Franchise Advisory Council to safeguard Ontario franchises' right under the author which art achieving critical improvement in franchise contracts. A retired seasoned lieutenant in Canada Armed Forces, Gomez served 11 in health services before transitioning to civilian entrepreneurship. He co-founded Frontline Healthcare, addressing gap in first responder and in veteran care, and introduced Ottawa to a thriving Parisian bakery cafe in partnership with Les Moulins Yapar in 2020. Gomez founded Ottawa Mortgage Services, OMS, blending its operational expertise with commitment to financial empowerment. OMS help clients navigate mortgages and real estate investment with transparency and reliability, ensuring tailored solutions for first-time home buyers, seasoned investors, and unique financial situations. Gomez is a diverse background, reflecting dedication to innovation, advocacy. Am I? Okay. Oh, sorry. I thought I'm sharing. I was sharing. Give me 1 second. Let me reshare again. Okay. So that's Gomez. And so Gomez's diverse background reflects its dedication to innovation, advocacy, and supporting communities through tailored solution and strategy. So this Gomez, I'm going to bring in on board. Gomez right now is also going to do a little introduction himself, how he started and how he get to this point, and how he can help us today to achieve our dream. So Gomez.
Thank you very much, Adishola. I really appreciate the kind introductions.
Can
you hear me well?
Yeah, we can hear you.
Wonderful. Thank you, everybody, for taking the time on a busy Saturday to join us. Hopefully, we will be able to provide a very in-depth knowledge, not only in terms of the current mortgage policies, but also how to help you achieve whatever it is that you're looking to do in terms of personal investments, whether it is through A lending, B lending, alternative, or private solutions. Our role is to educate and guide you through the process. You are ultimately at the driving force to determine what your vision and goals are. Our role and goal is to help you identify what those situations can be, what are the risks and risk mitigating factors, where is Bank of Canada and the government today, federally speaking, policy-wise, where are they expected to go over the next 2 to 3 years, and then from there, depending on what your exact specific circumstances are, we can eventually at one point do a one-on-one session to critically create the roadmap so that you can get into the investment space, whatever that is for you. For some individuals, it's simply purchasing a home for the first time. For other individuals, they may already have a home and they're looking to create an investment for the future for themselves and for their children. Ultimately, at the end of the day, diversification is key so that not all of your investments are in one situation. With Adishola and his wife, with their taxation planning and wealth management, they've been able to help countless number of individuals structure their particular investment situations. It's not enough just to be able to purchase a property. Nowadays, with post-COVID high interest rate environments, it's important to make sure that you're investing with the right mindset and with the business planning to make sure that when you do put a single dollar into a property, you have the return on investment, irrespective of whether it's an investment portfolio or a property for yourself to live in. You want to make sure that that property doesn't depreciate, but in fact appreciates irrespective of the market. The old adage, knowledge is power. The purpose of today's conversation is to get that knowledge and then moving forward from there to help you navigate through step by step, whatever that situation is for you. Today, it will be a very long meeting, but it will be a very fruitful meeting. When it comes to questions, my advice would be to write the questions down, and then at one point we will stop periodically to take questions through the text box. So if you do have questions, at one point I will pause and say, okay, any questions, you can type those questions in, and then I'll answer those. At a later time, we can also book one-on-one sessions to individually address situations so that whatever your concerns are, whatever your situation is, we can consult and navigate through that process. Adishola, may I share my screen?
Yeah, you go ahead.
Perfect. Thank you very much. So our journey begins here. As Adishola said, my name is Gomez from Ottawa Mortgage Services. I come from a business background, franchise background, military background. When you're young, they advise you to pick a career path. In my case, I couldn't pick one because I liked everything. And so I followed my passions, and I've been able to navigate myself through my own career and my life and be able to create not only an investment portfolio, but also a business acumen to be able to be at least free from the structured environment. And that is not an easy process, but as you will see today, everything is critical. Comes to budgeting, comes to numbers, comes to business planning, comes to understanding the rules and regulations that are set up within Canada, but also understanding once you understand how the game is created, then you can navigate through and create the structure for what it is for yourself. For the purpose of today, we will focus on specifically mortgage and home buying process. At a later stage in the future, we can do one-on-one sessions for investment portfolios. Towards the end of this presentation, we will highlight investment portfolios and corporate structures at a very surface level because we have a wide demographic of audience today. At a later time, we can get more and more in depth and very specific to what your goals are. When you meet with a consultant, whether it is a mortgage broker like myself or a bank agent, the process begins by understanding your financial situation. When it comes to the financial situation, the bank heavily looks at your current debts. These could be your credit cards, lines of credit, car financing, student loans, any type of credit facility that you may have with an outstanding payment on a monthly basis. They assess your credit score. They assess your down payment. Where did the down payment come from? What is the history and nature? How did you collect your down payment? And of course, employment history. Everything with the A lending spectrum that are federally regulated is heavily derived on income and how you source your income in Canada. Having said that, there are a variety of different banking solutions that provide some alleviation and flexibility when it comes to income. Not everybody is directly employed. Individuals like myself are corporate individuals that have corporate structures and are self-employed. And so we will talk about that as well, how to qualify with a bank when you are self-employed. The very first thing that the bank looks at, apart from income, apart from credit, apart from down payment, one of the most measurement important criterias for calculating a pre-approval or an approval is the debt service score or the debt ratios. This is probably one of the more important slides for you to remember. You feel free to contact Adishola. This PowerPoint presentation can be made available to you, no problem at all. So don't worry about taking notes down. You can have this PowerPoint, not a problem. The two measurement criteria that the banks heavily look at are gross debt service and total debt service. The gross debt service is a calculation that is derived by your principal and interest payment for the property that you wish to purchase. The principal and interest payment is basically your mortgage payment. Now, for the purpose of this calculation, the number that the bank uses is based on what's called the stress test. The stress test is 2% more than the rate that the bank is giving. The stress test is important, and it was implemented over 10 years ago after the 2008 market crash. The reason being, individuals in 2009 and 2010 during the market recovery when interest rates were low were taking advantage of the low interest rates and buying properties that they could not afford. As a result, the government started to tighten up policy and implement measures. And one of them was the stress test, where if you can afford to purchase a mortgage with a calculation 2% more than what the bank is offering, then they will provide an approval. And so, for example, if the interest rate that they're offering you is 5%, then for the purpose of this calculation, the interest rate that they would use is not 5%, but 2% more, which is 7%. The implication here being that by the end of this calculation, if your numbers are within the approvable criteria guidelines, which I'll show in a moment, then they will approve you for the 5%, as long as you can be able to withstand a higher payment. So to define gross debt service, once again, it's your principal and interest payment for the per property that you wish to purchase at the stress test interest rate, the property tax of the property that you want to buy, the condo fee of the property you want to buy if it's a condo, heating cost of the property you wish to purchase, divided by the total income of all of the applicants times 100. This, by the end of this calculation, if your percentage is 39% or below, that is good. That is what the bank is looking for. The second measurement is your total debt service. They are taking the same calculation as the GDS, which is principal and interest, property tax, heating costs, condo fee, plus all your other debts, all your other liabilities. This includes, again, your credit cards, lines of credit, child support, alimony, car financing, student loans, any fixed payments that you're making on a monthly basis. They add that to the calculation to take account for all of the debts that you pay, divided by the total income times 100, and that percentage has to stay below 44%. And so as a recap, GDS and TDS is the golden standard of measurement for A-lender banks. There are a variety of different banks in Canada, which I will get to in a second. But when it comes to A-lender banks, which everybody wants to go to because they have the lowest interest rates in the market, to be able to qualify for them, we have to be able to make sure that income is strong, credit is strong, and the gross debt service and total debt service is within these guidelines. In addition to the GDS and TDS, we look at the credit report, the credit rating. A credit report is the history of how you have a relationship with your financial obligation. It is created when you first borrow money for any credit product, whether it is through banks, finance companies, credit unions, retailers, cell phone providers. They will all have the ability to report to Equifax or TransUnion. These are the two institutional agencies in North America, both in the United States and in Canada, where automatic information on a monthly basis from all credit providers, MasterCard, Visa, cell phones, etc., are uploaded automatically to the system. When it comes to mortgages, almost all the banks use Equifax as a golden standard. However, with certain banks like Desjardins and Scotiabank, they do also use TransUnion, but as a secondary measure. Sometimes information with Equifax is not 100% accurate or it is delayed. And so sometimes the file could get declined. If that's the case, we always ask that bank, can you please pull the TransUnion score? They will oblige, but it is important to note that TransUnion is a little bit more generous on the credit report rating than Equifax. And when we're talking about the money lending game, the banks are as risk averse as possible, which is why they use Equifax first, because Equifax takes into more considerations on the payment obligations. Therefore, Equifax ratings tend to be a little bit lower than TransUnion. These items that you include in terms of the credit report, they're assessing what are the debts that you have. Do you make the payments on time? Do you have any missed payments? How many times have you missed payments? And have you ever gone over the credit limit? For example, if your credit card is a maximum credit of 5,000, did you go in a month over that? Did you go 5,500 or 6,000? Are you beyond the limit? And if so, did you pay it off right away, or did it stay as a balance for a month or two or a couple of months? All of these measurement criteria are heavily assessed. When it comes to credit reports, there are so many factors that we can go into. That conversation is a good 20, 30-minute conversation on its own. If you have any credit issues, or if you think you have credit issues, or you simply require some guidance on how to build your credit, we can definitely meet one-on-one video call, and I can help guide you through the process after reviewing your report. It is important to make sure that you keep your maximum usage up to or below 40% of the maximum limit in order to keep your credit score high. There are a lot of other strategies that you can employ as well. If you don't use your credit, that is also going to impact you negatively. The entire system in North America, whether it is in Canada or in the United States, it's built on the use of credit, whether it is credit cards, cell phones, lines of credit, mortgages, student loans, car financing. It's not that they want you to be in debt. What they want is to measure how well you use your debt. So if you're not using your credit card, or if you're closing your credit card after usage, that will negatively impact your report because the system doesn't know how well you're managing debt. So you could have no debt, but if you're not using even a small amount, then there's no relationship that's being able to be shown with the credit reporting agencies. As a result, that could also impact your credit score. When we are looking at banks, I'm actually going to take a quick pause here and shift over to another screen. Adishola, can you see the screen?
Yes. Goodness.
Thank you.
Yeah, we
So in Canada, we have 4 categories of banking solutions. We have A banks, we have B banks, we have alternative banks, and we have private banks or mortgage investment corporations. For the beginning portion of our conversation, we will talk about the A banks. The A banks are the banks that everybody wants to go to because these are the golden standard with the lowest interest rate in the market. These other banks that are also federally regulated by the government are there to provide a bandage solution or flexibility to the individual who does not qualify here. And so we will talk about these, and we will talk about the benefits and the pros and cons, the cost for these type of banks a little bit later. For now, we're going to talk about the A banks. And so when we're talking about the A banks, I'm just going to go back to the presentation. Within the A lender spectrum, when we are looking at the GDS and TDS, doesn't matter what bank you go to. You could go to TD, you could go to BMO, you could go to First National, you could go to Desjardins. All of the measurement criteria are federally regulated by the government. And so as a result, the gross debt service and the total debt service is defined by 39 and 44%. And so I'm just going to go back and remind you again what this is. And I'm emphasizing this and taking the time on this one because it is the most important aspect of a pre-approval or approval when you're purchasing a property or applying for a credit card or line of credit. Gross debt service, very simple measurement. It is your housing cost divided by your income for the house that you want to buy. Total debt service is the housing cost plus all your other debts divided by total income. Those are the 2 measurements that they have to look at in order to approve any borrower. And so with an A bank, there are many types of A banks. There are 3 subcategories. You have commercial banking. Commercial banking, everybody knows. It doesn't matter. Once you're born, you most likely have some sort of an account with any one of these banks, potentially. TD, Scotia, CIBC, RBC, Bank of Montreal. We call them the top 5. These banks have been around for more than 100 years. They are in every province, every city, coast to coast. They are bricks and mortar infrastructure banks. They are in every city, offering you everything that you can think of. Credit cards, lines of credit, mortgages, car financing, student loans. They give you a plethora of products. Now, because they are a business and they have a physical location and they have product diversity, their interest rates are not always the best. Sometimes they are, sometimes they're not. It depends on the market situation. It depends on their funding criteria. As a result, when an individual is looking for a mortgage, we don't always necessarily have to go to the commercial bank when we are looking for the best interest rate possible. Sometimes you're stuck and you have no choice but to go to these banks. Other times you don't have to. The second type of bank is your credit union. And so credit unions are membership banks. You pay a membership fee on an annual basis to be a part of that bank. They are what's called a cooperative. Desjardins, Alterna, Meridian, B2B, which is Bank of Laurentian. There's a plethora of those banks that are out there. These are some of the top 4 that are in Ontario alone. Credit unions address the immediate need of the community that they are in. So, for example, we have some of our friends here today from Edmonton, others from Nova Scotia, and so in those provinces and in those cities, they will have specific credit unions that are not Desjardins, Alterna, or Meridian. They might be a different name and a different bank that is addressing the specific need of that community. Credit unions sometimes have better rates than the commercial banks. Sometimes they don't. Sometimes they have higher rates. Other times the rates are the same. It really depends on the specific community that they're servicing. For example, if Desjardins is in Smith Fall in Ontario, they will focus more on farm products because they are in a community where there's a lot of farmers. Whereas Meridian in downtown Ottawa will have more business products because in the downtown core, you have a lot of business transactions happening. And so different credit unions will focus on the needs of the different communities that they're servicing. Sometimes Desjardins in downtown Ottawa will have a slightly different interest rate than Desjardins in Quebec, mainly because it's a different segment of the market they're addressing. So unlike TD, Scotia, CIBC, RBC, BMO, where they're nationally standardized, credit unions are specific to the location that they're in on a case-by-case basis. The third type of bank is your virtual bank. These banks have become very popular in the last, I would say, 5 to 8 years, more so in the last 4 or 5 years, mainly because they are virtual, they're online, there is no physical location that you can go to, and they only offer one product, which is mortgages. Because there is no physical location, because they don't have the demand for the different products, their cost of operation is low. Therefore, they pass the savings to the consumer, meaning the interest rate is oftentimes 8 out of 10 times cheaper than going to these banks here, as long as you qualify. If you can qualify with them, they will give you the best interest rate. The advantage is that they will give you the better rate. The disadvantage is if you are dealing with a segment of population that is not comfortable with online banking. For example, my parents who are in their late 60s, turning 70 soon, they prefer to actually still go physically to the bank because that's their generation. They're not comfortable going online. As a result, depending on the comfort of the client, depending on the nature of their application, we talk about all of these things with the borrower to make sure that it's not always just about the interest rate. It's also about the convenience that they're looking for. My father wants to physically go in and see the teller, whereas my brother, who's younger than me, has his mortgage with First National for his rental property. He doesn't care because he's young, everything is online, everything is on his phone. That's the world that he's living in. Those are two different worlds. The last measurement criteria with the A banks is the credit rating. And so the credit aspect of the assessment for the application is rather very stringent when we're dealing with these banks, the A banks. Doesn't matter if it's a commercial bank, credit union, or virtual bank, they all conform to these guidelines because these guidelines are federally regulated by the government. And as a result, if your credit score, if you know your credit score is, let's say, for example, 680 or more, it could be 700, could be 750, could be 800. Anything above 680, you will get the best loan and interest rate that the bank will give you because you have demonstrated through Equifax that you make your payments on time, you have a healthy relationship with debt, and you keep your debt ratios very low. And so any individual that has a credit rating of more than 680 will get the best buffet possible with all of these banks, with the best offers. If your credit score is lower than that, whether you are new to Canada or perhaps you have a little bit of more debt because of life circumstances, whether you have children or perhaps you went back to school and you took a student loan, or perhaps you needed a second vehicle because now you have an extra baby. And so if you have too much debt on application, you're still making the payments, but it is a little bit a lot for your credit bureau and it's a relatively fresh debt, then the credit rating could slightly drop temporarily for a few months until the system algorithm recognizes that you're always making your payments on time. And so if your credit score is above 650, but below 680, then the bank will reduce the loan that they give you. So they won't give you the maximum loan possible based on the credit risk that they see. They will reduce the overall amount that they can approve you for. And that is subjective between bank to bank. And so we would have to trial test that if your situation is in that type of situation. If your credit score, for whatever reason, is 600 to 650, then on a case-by-case basis, the bank may give you a loan. Any one of these banks could give you a loan, but as an exception. They have to look at your income. They have to look at your 3-year history of credit. They have to understand why is it that your credit score went down. Things happen, and the banks are not oblivious to that. They take the human approach, the common sense approach. And so they say, okay, well, what was the case? Was there a separation? Was there a marriage breakdown? Right? Maybe there was a marriage breakdown and somebody was infected with COVID and perhaps a family member passed away. And so for a short period of time, there was a life stressful event which caused the individual to have a memory lapse and they forgot to make a payment. Things happen. As a result, the bank on a case-by-case basis can still make an offer, but at a reduced loan amount. Or they might say, please just wait out another couple months, let your credit bureau go back up, and then we will take a look. The benefit of working with a broker like myself is you're not stuck with just one bank. My role is there to help you navigate through all of the different solutions. As a result, where one bank might say no, and they may tell you to wait, another bank will be willing to take the risk and say, sure, no problem. The interest rate might be the same, but at least they're willing to move forward. And depending on when you are shopping for a property, if you're shopping for a property at a time where it's critical, where there's demand to buy, or you found a property at a very good price in the location that is perfect for you, for your situation, and you want to move forward, then this is at least an opportunity for you to still try to navigate forward. Otherwise, we sit down and we reevaluate your credit and we say, okay, well, here's the new goals and objectives. Let's try to pay off XYZ debt amounts and let's reassess in about 3 months. Once the credit score jumps above 680, you're ready to rock and roll. Once we have assessed income, we have assessed credit, and we have a very clear idea of the financial situation along with the debts, then we have to assess the down payment. I'm sure you've been watching the news over the course of the year, and perhaps you might have noticed that TD was caught in a rather pretty bad implication as of April this year, where they had to pay $3 billion in penalties to the federal government because they were caught money laundering for the cartel. It's not that the bank was intentionally doing it. Unfortunately, the banks are a large entity, and as a result, sometimes you're going to hire individuals that are perhaps with bad intentions. And so there were some loopholes or some gaps in the bank policies that allowed specific bad individuals to do some bad things. As a result, the entire market is now tight when it comes to banking regulations, whether it is assessing down payment, whether it is assessing income, whether it is assessing the debt ratios, or anti-money laundering policies if you're trying to bring money into Canada from a different country of origin. Doesn't matter if the money's coming from the United States or if it's coming from China, Rwanda, Middle East, India. It doesn't matter. It could even come from UK. There are specific policies now that are being put in place this year to make it tighter and tighter. In some communities, there are communities like in my community, we have a tendency to pool money together where you have 5 or 10 families that will put money into a pot, and every month we will contribute towards this pot, and then every month one family will get that money and they will do something with it, whether it is to pay taxes, buy a vehicle, maybe save up money for down payment. That type of saving process is not recognized in Canada. And so if that is your method of saving up for down payment, that is okay. But just keep in mind that we cannot use that as a source of down payment. Or sorry, I misspoke. We cannot show that as a source of down payment. And so we just have to be very careful on what we show the bank in terms of the bank statements. I'm going to touch on this topic in a bit because it's in part of my slide. But the first portion when it comes to down payment with A banks is this first criteria. When a borrower has 5% to 19.99% down payment, the minimum down payment is 5% in Canada. But if you have saved up 5% to 19.99% down payment, all mortgages for all properties must be default insured. This is mandatory, and there's no way around it. Default insurance is provided by one of the 3 insurance companies in Canada. The 3 insurance companies in Canada are CMHC, Canada Guarantee, and Sagen. The purpose of the default insurance is there for the benefit of the bank. Should a borrower not make their payment obligation, and should they default on their payment, the bank will foreclose on the property, sell the property, and if the property value was lower than when the borrower bought the property, if there's a shortfall, then the insurance company will guarantee the shortfall and the loan for the bank. As a result, because the bank they're guaranteed their money, they give the best interest rate to this type of client or this type of borrower. the borrower who's putting in 5 to 19%. The downside or the consequence is the cost of the insurance is paid by the borrower. It's embedded within the mortgage and it's paid over the lifetime of the mortgage. And so what is also important to note is CMHC, Canada Mortgage Housing Corporation, is a crown corporation. They are the ones that create the policies for income assessment, for credit assessment, for down payment assessment, for home evaluation assessment. They are the ones that create the policy, the governance of it, and then they give it to the banks, and the bank's role is to enforce that policy. And so if you go to TD and they decline your file, it is very difficult to take it to another bank and get it approved, because if you're this type of borrower with 5 to 19%, and if they declined your file based off of any one of those criterias, income, credit, etc., chances are other banks will probably decline it as well, because the banks are not the ones that create the policy. It's the government, Canada Mortgage Housing Corporation. And the reason is because they're the ones providing the insurance, and the beneficiary is the bank. So if the bank is benefiting from this insurance, they have no choice but to follow this policy in order to have that insurance on that property. If they don't follow that policy, then they are not going to get the insurance. If they don't get the insurance, then their mortgage, their debt is not guaranteed. It's a business transaction for them. As a result, when we are doing the pre-approval as brokers, we have to make sure that we are critically looking at income, critically looking at the credit score and the credit reports very carefully, the down payment history very carefully, and helping you navigate through that to make sure that everything is correct from the beginning. And that's why Adishola said in the very beginning of this presentation, sometimes it could be 6 months. For some people, it could be 2 years. It depends on the situation of the person. It depends on the circumstances. Not everybody is the same, and not everybody's circumstances are the same. And so the biggest goal here is knowledge is power. Once you have the education, then you can create the process, create the way for yourself so that you can eventually get into the house that you want. If your down payment is 20% or more, in this situation, things change. Now, with the top 5 banks, commercial banks in particular, TD, Scotia, etc., individual bank policies prevail because insurance is no longer required. Legally, you're no longer enforced to have insurance. You don't have to get that default insurance. As a result, individual banks will have different policies. If one bank declines your file, another bank could approve your file. I'll give you an example. Up to 2022, Scotiabank and RBC were not giving good interest rates. They were giving quite bad interest rates. You could get a way better interest rate with TD or with Bank of Montreal. The reason is because TD and Bank of Montreal were focusing on clean clients. They were focusing on strong guaranteed income, like government employees, high-tech guaranteed income, strong credit. They wanted the AAA clean client, low risk for them. And so they were willing to give heavy discounts to get that client. RBC and Scotiabank had a different strategy. They were focusing on clients that were not approved by TD or BMO or CIBC, and they couldn't get approved with the other credit unions or virtual banks. Scotiabank and RBC would tell the brokers, listen, send us the file, let us take a look at it. Our risk appetite is high right now. We are willing to give a loan, but we're going to charge for it. And so their interest rates would be a little bit higher. So they were not looking for the best client. They were looking for clients that need help over time, and it will take time for them to correct whatever those issues are. And so by Scotiabank or RBC giving the loan to those type of clients, now that client is with that type of a bank. When all the other banks said no, these banks said yes. And although they're paying a little bit of a higher rate, at least they got the investment that they wanted, and they did not have to go to the B bank, alternative bank, or private bank at a higher rate. And so this was the strategy that Scotiabank and RBC had. Fast forward to this year in 2024, it's the exact opposite. TD was caught with their money laundering schemes with the cartel. Bank of Montreal has had 3/4 of very poor investments. CIBC has lost about 10% market share. Scotiabank and RBC are the only ones right now that are going toe-to-toe, giving aggressive discounts. They have changed the way that they're doing business. As of July of this year, both of those banks are heavily competing against one another. The rest of the market is charging 4.8, 4.9%. Scotia and RBC can still give you 4.3% because they are fighting each other, trying to get all of the clean clients now before the interest rates drop and demand goes up. And so different banks have different strategies. This is where the broker comes in to help you navigate through that. What is happening today will be different than what will happen tomorrow. And so we always have to evaluate the market before you enter the market so you know exactly what the shot is for yourself. When it comes to credit unions and virtual banks, these two types of banks, they pay for the default insurance when you put 20% down payment or more. Because of the fact that they are paying for the insurance, the property is insured. And because the property is insured, in this situation, the approval criterias have to follow CMHC for income, for credit, for credit score, for down payment assessment, for evaluation of property. All of the measurement criterias have to respect CMHC guidelines. Why? Because they want the property insured. They want their mortgage guaranteed. As a result, their interest rates are a little bit higher, but overall still lower than the commercial bank. And so the virtual bank and credit union will say, listen, I'll give you the best rate, but I can't give you the highest mortgage because I want to have low risk. So for low risk, if you are getting approved, they'll give you the best rate. Commercial bank will say, listen, I may not give you the best rate, but I will give you more debt. I will allow you to buy at a higher price. So sometimes it's not always about interest rate. We have to take it on a case-by-case basis to look at what is the specific need of the borrower. In addition to down payment, this is something that borrowers often forget to budget for. And by the time they realize this, it's a bit late, and then they have to quickly talk to family for more money. It's not enough to have money for down payment. You also have a transaction cost. It doesn't matter what property you buy. It doesn't matter what bank you go to. You still have to have a closing cost. This is the cost of administration to facilitate the cost of the transaction to purchase the property. So for example, part of the closing cost includes your land transfer tax. You have to pay a tax for when you're purchasing the property to the province. If the bank requires an appraisal, you have to pay for the appraisal. It could be $450 to $500 plus tax if it's required. It's not always required. Legal expenses, you can budget for another $2,000 to $3,000. The legal expenses are quite numerous. You'd all need a real estate lawyer to do the transaction. The real estate cost will cover title registration with the province, title insurance on the property, default insurance tax on the property tax certificate to order from the city, whichever city that you're a part of, the cost of the legal administration, the software, the disbursement costs, the wire fees, the list just goes on. When you are trying to get pre-approved, the bank wants to see at least 1.5% of the purchase price in your savings. When you talk to a lawyer, the lawyer will say, please budget up to 2.5%, because the land transfer tax increases as the price of the property goes up, so on and so forth. So the bank wants to see 1.5%. However, the lawyer will tell you, please budget for 2 to 2.5%. I'll give you an example over here. Let's say you are looking to purchase a $490,000 home. The minimum down payment is 5%. And so let's say you saved up $24,500. $24,500 is going directly as your equity investment in the property. And the bank wants to see closing cost. And they want to see that in your bank account. And so the minimum amount that they want to see is 1.5%. And so for a $490,000 home, they will want to see $7,350 at a minimum, plus your down payment of $24,500 for a total of $31,850 in your bank account before you buy the house. However, in reality, when you speak to a lawyer, they will say, please budget up to 2 to 2.5% because land transfer tax could be different. Title insurance costs could be different. Default insurance tax could be different. Property tax in itself on the municipality that you're in, maybe the property taxes went up and now you have to cover the difference. As a result, you have to budget at least up to 2%, if not 2.5%. And so in reality, you can aim to have $7,350 to show the bank, but please try to have at least a little bit more, $9,800 in this particular case here. When it comes to documentation, documentations are required in order for the bank to review your file. This list here is not an exhaustive list. This is a summary of a basic list. There could be more documents required depending on the individual specific circumstances. So for example, every bank and every single lawyer will ask you for 2 pieces of ID, a driver's license, a PR card, a passport, health card, etc. They need the front and the back of the card, and it has to be valid, no expiration. They need to verify your identity because there's been a lot of fraud happening in Canada over the last 5 years. Employment letter. We need to know, we need to have an employment letter or a record of employment with the employer that you're working for that indicates that you've been working there at least a minimum 3 months. You're in a full-time or part-time position. The bank doesn't care if you're full-time or part-time. What they care about is that it is permanent in nature. What they care about is that you're not on probation and that you're not on a contract term. And they want to make sure that you have at least some sort of a 3-year history working. In some cases, you can get an exception. Perhaps you were in school and now you're done school, you're done your master's, you're done your undergrad, and you got a full-time job with a high-tech firm. No problem. In that case, they want you to work at least a minimum of 3 months. They want to see the deposits. They want to make sure that it's a legitimate job and not fake. And they want an employment letter and they want the pay stubs to show that history. Pay stub wise, they will critically look at the pay stub. They will look at the year to date to make sure that all of the deposits are adding up. With the pay stubs, there are deductions as well. You pay CPP, you pay employment insurance, all of the calculations are proper. There's no fraud happening. So they look at the pay stubs to make sure that when they calculate the income, the gross income deposits, they add up to the number that's written on the employment letter. Depending on the circumstance, it's not always the case. They will ask for your T4s. In some cases, they will ask for 2 years worth of T4s. Same thing for your notice of assessment, which is your tax return. They for sure will want to see the previous year's tax return to make sure that you paid your tax and that there's no taxes owing. And in some cases, if you're self-employed, they will want to see 2 years of tax return. They will definitely want to see your credit bureau. They want to see the credit report. They want to make sure that the credit rating is good and they get to assess the credit relationship that you have with your debt. That's why a SIN number is required. If you are new to Canada, you are a permanent resident, there are some additional documents that could be required because maybe your credit rating is not high enough because you're new. And the government knows and the banks know that it takes time to build credit. And so you don't have to wait 2 years to buy a house. If you have a full-time job, you've been in Canada for a few months, no problem. As long as you've had the full-time job for a minimum 3 months, the bank will say, okay, even if your credit score is low because you're still building credit, that's no problem. They will use alternative sources of credit. And that could be your credit card statements. They want to make sure that you pay your credit on time. They can look at your rental payment history by asking you to get a letter from the landlord and showing the bank statements that you make your payments on time. They can also ask you to show your hydro bills, your utility bills, your cell phone bill, your insurance payments, any one of these combinations to help you prove that you make your payments on time so that you're not stuck with just the low credit score. They can give an exception and allow you to purchase something at whatever it is that you're looking for, as long as it can be approved. And this is the alternative method to assess credit instead of just a credit score. Keep in mind, this is only an option for individuals that are new to Canada or who are permanent resident. If you're an individual that has been in Canada for more than 5 years, this is not available to you. This is only available for people that are new to Canada because they're trying to establish credit but have not done yet. When it comes to down payment, it is important to note that the bank needs to see legally the last 90 days of the transactions of all of the bank accounts that you're going to use for your down payment and closing cost. And so anything that's more than $1,000 deposit coming into the account is assessed, and they need to know where that money came from. And if that money came from outside of the country, then that money has to be in Canada for at least 30 days before you can close on the property. And so when it comes to down payment, the banks and the federal government have become more and more stringent in assessing down payment because of fraud, because of money laundering, because of all of the issues that you see on the news today. And so, for example, let's say you were to buy a property today and you successfully won the purchase sale agreement. The 90-day begins as of today, from the day of the application. And so the bank will want to see the last 90-day history from today backwards of all of the bank accounts that you're intending to use for your down payment and closing cost. And so if, let's say, the file was submitted on March the 1st, then they need a full 90-day history of December, January, and February. And if, let's say, December the 2nd, they saw a $5,000 deposit from somewhere, then they need to ask, where did that $5,000 come from? And then they will want to see the bank statement of where that came from. If it came from your own account, perfect. We then need to get another 90 days from December the 2nd backwards. And so in some situations, we end up having to show 6-month history instead of just a 3-month history. So a few minutes ago, I mentioned to you that in some cultures, my culture included, we sometimes pool money within families and communities. And as I mentioned earlier, it's not a recognized form of savings or down payment in Canada. And so if you are involved in that type of a situation, that's okay. Just be very mindful that if you are receiving money and depositing it into your account, we have to wait at least 4 months before you can purchase a property, because we need to show a 3-month history of money in your account. If they see large deposits coming in, especially a cash transaction, because that's how you receive, the $5,000 or $10,000. Well, now we are not in a position to explain that because that method of money accumulation is not recognized in Canada. Legally, it's not recognized. As a result, we have to be patient. We have to let the money stay there for an extra month to 2 months. And then you begin shopping after the 4th month, so that when you find a house and we are required to show the 90-day statement, we don't show the deposits coming in. The bank documents are clean and you don't have any problems. And so what can you use to show down payment? You can use personal savings. You can sell a property. You can show your RRSP, TFSA, mutual fund investments. You can have a gift from an immediate family. A gift from an immediate family, by definition, would be your mother, your father, your brother, your sister, your children, your grandparents. Unfortunately, by definition in Canada, an aunt, an uncle, a cousin is not an immediate family. And so we may have to be a little bit creative if you are getting a gift from somebody of that nature that isn't by definition your brother or sister, mother or father, or an immediate member. So we have to have that conversation with you and that person, because there are specific legal documents that have to be signed declaring that that person is your immediate family member. Now, if you are in a situation where you are expecting gifted money coming from family, you have to understand that a minimum of 5% of your down payment still has to come from you, and you have to prove that it came from you. Otherwise, if you are trying to save up money and you don't have 5%, that's okay. let your family give you that money, let them deposit that money into your account, but now just be patient. Wait 5 months before you start looking for a property, because at one point we need to show the 90-day bank statements. And if they see this amount of money going in, they will ask. Gifted funds are okay as long as you have 5% coming from you. If the money has been in your account for more than 4 or 5 months, legitimately it is your money at that point. We don't have to declare it as a gift. It is your money untouched, and we can just say that it's savings that you've accumulated over time. You can also use inheritance as money. There are some people, some investors that try to leverage purchase, meaning that they try to use debt to buy debt. It is high risk, it's very volatile, and it is one of the things that has caused issues in the market with property values. Now, the banks can, on a case-by-case basis, allow you to use line of credit to buy a property, but keep in mind, you have to have at least 5% minimum from personal savings as a down payment. Some of your closing costs can come from your line of credit, but not your down payment. They need to see the down payment coming from you. So you can use borrowed funds for your closing cost, but they have to factor the liability or monthly payment into the debt ratios. As a result, your maximum buying power can reduce because you're using debt to get another debt. If you're buying a property more than $500,000, 5% is not enough. You need 5% of the first 500,000 plus 10% of the difference of anything above 500,000. So, for example, if you're buying a property for 700,000, the minimum down payment is 45K. How? Well, for the first 500,000, you need 5%, which is 25,000. For the next 200,000, which is 700K minus 500K, which is 200K, you need 10% of that. 10% of 200,000 is 20K. When you add the two up, 25,000 and 20,000, your minimum down payment requirement for a $700,000 home is 45,000. In addition to that, you need closing cost. The bank will want to see up to 1.5% of 700,000 as a closing cost. That would be 10,500. When you talk to your real estate lawyer, they will tell you, please budget for more. Budget up to 2 to 2.5%. So please anticipate to have up to $14,000. If you need it, great, you have the money. If you don't need it, if the cost ends up being lower, if it's 11,000, perfect, you save 3,000. As a first-time home buyer, there have been new policies that have come in within the last 2-3 months. So our conversation today is very important because there's some new options that are available to first-time home buyers that were not available before August of this year. One of the first items is 30-year amortization, available for all first-time home buyers and any construction purchases, regardless of down payment or insurance mortgage status, starting December the 15th. So starting within the next 17 days, you will have the ability to purchase a property and increase the amortization up to 30 years, even if you're putting 5% down. At the moment right now, that is not the case. If you have 5% down payment, 15% down payment, up to 19% down payment, you are not allowed to have a 30-year amortization. As of December 15, they will allow that. Why? So that the interest rates are high, the prices of properties went up, and so to allow people to qualify and to be able to afford the payments, they're allowing the amortization to increase so that instead of paying the mortgage in 25 years, you can choose to pay over 30 years and reduce your payment obligation. Increased insurance mortgage cap. As of right now, if you have the income and you have the down payment, the maximum that you can buy with CMHC as a default insurance with 5% or 10% down payment is up to $999,000. Anything above $999,000 requires you to have a minimum of 20% down payment or more. After December 15 of this year, they are now increasing that from 1 million to 1.5 million. What that means is you can now pay up to 10% on the property if you're buying a property for 1.499999. So up to 1.5 million, you could put 10% down. This is to help individuals, as long as they can qualify, to purchase properties in higher priced areas like Toronto, Vancouver, areas where townhouses now are close to 900,000 and single homes are now over 1 million. They have expanded the eligibility. And so for reforms addressing affordability challenges in high cost market areas, for example, Vancouver or Toronto, opening options beyond condo and detached homes by allowing the 30-year amortization and by allowing the mortgage price cap beyond 1 million. Affordability of improvement with longer amortization and monthly payments, making mortgages more manageable through the result of higher interest rate costs over time. I'm just going to skip this entire page and just go on to the next page. The key for the programs as a first-time home buyer, you have some additional options when you're saving your money. Number one, you can use the new program that came out last year, the First Home Savings Account. Every bank offers this in addition to your TFSA and RRSP. And so the benefit with this particular product, you can go to any bank, you can go to TD or Scotia and open up an FHSA account. You can put in maximum annually $8,000 up to a maximum of $40,000 of money into that account for the purpose of buying a property. When you put that money, and Adishola can talk more about this, when you put that money into that account, you can, in the following year, claim that as a tax credit. And so that $8,000 can be added to the deduction on your taxes the following year and reduce your income on the CRA tax filing by $8,000, just like the RRSP. And so there is a benefit there that the government has now allowed. In addition to that, you can take that money out at any time when you're ready to buy a home. The second type of option is your RRSP. With the RRSP, the Registered Retirement Savings Plan, the purpose of that account is actually for your retirement. It is there specifically for a situation where when you're 60 or more, you're able to take that out as a pension. However, because individuals are having a hard time qualifying and buying properties and they need more money for down payment, the government allows you as a first-time home buyer and only a first-time home buyer to be able to take out up to $60,000 from your RRSP tax-free for the purposes of down payment. And it must be repaid within 15 years. And the payment begins after 5 years from 2022 to 2025. So if you buy a property next year, you have until 2030. After 2030, you have to begin adding money back into the RRSP to top it back up. That is a big difference than the First Home Savings Account. In the First Home Savings Account, you get the tax efficiency just like the RRSP, but when you take the money out of the FHSA, you are not taxed and you do not have to put the money back. As a first-time home buyer, you do have the ability to get land transfer tax rebate. And so when you're purchasing a property in the province, and in the case of Ontario, I know some of you are not in Ontario, but in the case of Ontario, you do have a rebate of $4,000. Every province has a different amount for different things. Ontario specifically is $4,000. In Quebec, they have a welcome tax. You claim it during the when you're tax filing. Adishola and Olubukunola will be able to talk to you more about that as well when you're filing your taxes. But in Ontario, when you're purchasing a property, the land transfer tax has a rebate of $4,000. It is your lawyer that adds that credit in the statement of adjustments at the time of closing. And so when you receive your final bill, it will already have a deduction of $4,000 automatically applied. So in Ontario, you don't have to apply to CRA. In Quebec, you do. Other key programs that they have are first-time homebuyer tax credit, non-refundable tax credit as a first-time buyer of up to $1,500 as of 2022, Adishola and Olubukunola will be able to talk more about that with you. If you're buying a brand new property with a builder, Mattamy, Minto, Claridge, etc., if you're buying a brand new property, you can actually claim the HST and get a rebate from the government. As soon as you close on the property, talk to Adishola or Olubukunola. They will help you in applying for the HST rebate, and then within a couple months, you'll receive that tax back into your account. Multi-generational homes. So we're going to talk about this very soon, where if you're buying a property for an investment, where you live in one unit and you have 2-3 other units as a duplex or a triplex, the government will allow you up to 15% as a tax credit, up to $50,000 for creating a self-contained unit. And the maximum credit that they'll give you is $7,500. What they're trying to do is incentivize Canadians to purchase properties and to create a second unit or a third unit if the zoning and location allows for it. The reason is because the builders are having a hard time building properties. We have more people coming into the country than the houses we have available. As a result, the prices of houses have gone up. And so one way to remedy that, the government has created this tax incentive to incentivize investors and entrepreneurs to purchase properties and turn a duplex into a triplex into a fourplex, so that there's more units available to rent out, so that over time, rent prices can come down and home prices can come down. Home accessibility tax credit, up to $3,000 credit for renovating your house for the purpose of creating a home that is available for somebody that is disabled, somebody that has mobility issues. The government has tax incentives for that as well. In addition to this, as of this month, you have more freedom to switch lenders. So if you remember from the very beginning, I'm going to scroll back up very quickly. Here, when we're assessing the GDS and TDS, we have to do the stress test, where in the calculation, when we are looking at the principal and interest payment, we need to add 2%. This is the case for if you are buying a house. If you already have a house and the mortgage is coming up for renewal, now, as of this month, for any individual, especially here today, that have a house and they're trying to understand what's happening in the market next year, as of now, if you're renewing this month, next month, or next year, you can renew without the stress test. And so if the interest rate today is 5%, on the calculation, I don't have to use 7%. I can use 5%. As a result, it increases the buying power, it reduces the debt ratio threshold, it makes it easier for individuals to be able to shop around from bank to bank. In addition to that, they are removing the stress test for uninsured buyers. Therefore, if you purchased a home with 20% down payment or more and went to TD or Scotia or BMO and it was uninsured, now it doesn't matter whether you're uninsured or not. You can shop around with any bank, including credit unions and virtual banks, who, as I mentioned before, have better interest rates than the commercial bank. Before, if you went with TD or Scotia and you put 25% down payment and you're renewing your mortgage or refinancing your mortgage, you're stuck because their rates are better than the insured companies, because the insured companies want insurance on the property. And if your property didn't have insurance, you're stuck with those top 5 banks. Now the government is making it easy so you can shop around, no problem. We're going to go through 3 examples with all the information that we learned right now to make sure that you understand the concepts very well. Here is a case study number 1. Mark and Sandy immigrated to Canada 12 months ago and received their PR about 5 months ago. Mark is a computer engineer. He makes $60,000 full-time as a salary. Sandy, on the other hand, is a PSW. She earns $20 an hour, part-time, 3 days a week, which is about 7.5 hours per day. And so how do we do the calculation? We take $20 an hour, multiply by 7.5 hours per day, multiply by 3 days a week, multiply by 52 weeks a year to determine her annual income. From there, the total income is $60K plus 23K for a total of 83,400. Mark has a credit score of 680. Sandy has a credit score of 720. They pay all of their bills and credit cards on time. And that is the reason why their credit score is strong. The down payment they have is 25,000. The closing cost is 8,000. And they want to buy something up to 500,000. They find a property tax 5,000, no condo fee, and the heating cost is $100 a month. Because their down payment is less, it's 25,000, they are a default insured client. So their down payment is less than 20%. Therefore, the interest rate for that is 5%. Therefore, the stress test is 2% more, which is 7%. As a result, when I do the calculation to see if they can buy the house for 500,000, their GDS and TDS is 48 and 48. A reminder, the GDS and TDS has to be 39 and 44. So what this means is what they're trying to buy is too high of a price. And so when we look at this example, what do? In this scenario here, although the credit score is good and one of the application is full-time, no problem, the debt ratio is too high, 48-48. So we have a couple options. Either we have to ask Sandy to increase her income, go start working full-time, to increase the salary to 110,000 on application. Mark is already working 60,000. And so if she can increase the income to a total income of 50,000, now we have 110,000. They can both afford to buy a $500,000 home. If that is not the case, because they have children and Sandy needs to be at home, as a result, we have to reduce the buying power from 500,000 to a maximum purchase power of approximately 390,000, depending on property tax, depending on condo fee, depending on heating cost. And so if the scenario was property tax was 2,000, condo fee was 350, heating cost is $100, and the total income is 83,400 because Sandy is still part-time, their maximum purchase power is 395,000. Why? Because the property tax and the condo fee is included in the calculation. If the property tax is higher, $3,000, but the condo fee is cheaper, $300, and the down payment and income is the same, the maximum purchase power reduces to 392. So even though the condo fee went down, but the property tax went up, the maximum they can afford to buy is 392. Very different, 390, 392, 395. Why? Because property tax, condo fees, they impact the debt service score. And so we have to look at each property on a case-by-case basis if our numbers are very tight with GDS and TDS. Second case study. Aziz and Miriam came to Canada 2.5 years ago. They have their permanent residency card, and they have 3 children below the age of 15. Aziz works full-time for Loblaws as a baker, $22 an hour, guaranteed 8-hour shift. So he's not on salary, he's a wage employee. He sometimes does overtime, sometimes 8 hours, sometimes 10 hours, but it's not guaranteed. It depends on the day. He began 2 years ago. He has 1 credit card, and he has a balance on that credit card of $5,000, and he's been paying that now on that credit card for $150 a month. And because that debt is on a credit card, his credit rating might be impacted. Miriam, on the other hand, is unemployed. She's not working. She collects $200 a month for child tax benefit from the government, which equals to $7,200 per year. This is a source of income we can use. As a result, we collect both of their incomes. We go to Aziz and we say, okay, you began working 2 years ago. Can you give me 2020 T4 and 2021 T4? And so we look at that and we look at, okay, well, he made $42,000 in 2020. He made $45,000 in 2021. We do what's called a 2-year average. And so I don't use 42K. I don't use 45K. We take a 2-year average and use 44K. Why? Because he has overtime from time to time. It's not guaranteed, but he's been consistently doing it for 2 years. As a result, this is the method of income calculation for this type of situation. Some of you might be in this situation. You might be working for a company. You might have made a little bit of money in 2022. You made more money last year, and this year you're making even more money. And so we have different ways to calculate income if it's not a salary. We add Marion's income to have a total income of $51,530. However, because Aziz had a credit card balance of $5,000 and he didn't pay that off, and he's been carrying that balance at 22% interest rate for 3 months, his credit score went down. And now his credit score is 652. However, Mariam, her credit score is amazing. It's 700. Because Aziz is the primary applicant with the higher income, unfortunately, we have to go by his credit score. And so if this is the case, what can they afford? If they have a down payment of 40,000, closing cost of 8K, and Aziz's brother gives them 20,000, they have a total down payment of 60,000. Current rate is 5%, stress test is 7%. When we do the calculations, because of Aziz's credit score being low, he is able to be approved for 389,000 because we have to go with a lower GDS and TDS ratio. However, if Aziz is able to pay off the 5,000 credit card, or perhaps bring the balance down to $2,000, and his credit score goes up from 650 to 685, then in that scenario, the GDS and TDS goes back up again, and the bank will allow them to take on more debt because the credit score is above 680, and therefore he can buy up to $435,000 home. This is a big difference from 389,000 to 435,000. Those are a complete different class of properties, completely different. Here, 389,000, you might be buying an apartment condo or a row home townhome that's a little bit old. 435,000, you're buying a relatively newer row home condo townhome with a lower condo fee. This is a very big difference in property class type. And so for somebody in this situation, it is actually smart to save up more money, to pay down the debt, and to raise the credit bureau, because this is a big jump in approval from 389 to 435. The last case study before we take questions, is Cedric and Christina have been in Canada for 4.5 years and are permanent residents. Cedric works as a personal support worker full-time. Christine works for the Ottawa Hospital as a nurse full-time, and she started that this year. Cedric has an employment letter that says he's working $21 an hour for 40 hours per week full-time, and he has been a PSW with the same organization for 2 years. The way we calculate Cedric's income is the following: $21 an hour for 40 hours a week for 52 weeks a year, it's $43,680. So based on the employment letter, he should be making $43,680 this year. However, in 2020, he made $35,000. In 2021, he made $40,000. So clearly this year he's making more money. The average of the last 2 years was $37,500. So do we use $37,500 for income? Do we use $40,000 for income? Do we use $43,000 for income? It depends on the situation. We have to look at the pay stubs. If the pay stubs show that everything that he has earned so far adds up to a projection of $43,680, perfect. We will use the higher income. If Cedric decided to take a break, maybe he went on vacation, maybe he decided to take a little bit of time off, and the pay stubs do not show that he is going to earn $43,000 this year, as a result, the bank will go conservative and they will use $37,500. Before I start talking about B lenders, I will open this group up for questions. If you want to type your questions on the chat box, I can review those questions and answer them. Please keep it limited to the content that we have so far and keep it generalized. If there are specific questions, we can book a meeting and talk about those as well.
Wow, Gomez, thank you so much. It's as if it's a refresher course for me, and I'm learning all over again. Thank you so much. Please, if we have about five some minutes for question. right now. So this is just the part A, and we're going to the part B. So it's going to the B lenders. As a matter of fact, it's mind blowing, and I'm learning so much. So I hope you guys are also learning too. If you're learning, let me see. Maybe we can't see anybody. Put it in the chat. If you're learning something, put 1 1. I want to see in the chat 1 1. If you're learning something new today, yes, please. Casey, thank you. Please put in the chat 1 1. I want to start rolling 1 1. If you learn something different today, I want to see. Maybe it's communicating, but for me, it's like thank you so much for the wonderful. Yes. There's a lot of information I'm also learning too. That's the fact that I have a mortgage. I've learned more. Yes, yes. Please, if you learn something, comment 1 and put it there. Yes, that's why we are here, right? So we want to learn new things. And that's not the fact that we had a mortgage. It was like I'm just listening to it for the first time again. And I'm learning so much. Put it there. If you learn something, just put it there. And that is why we created this webinar for us to learn so much information about mortgage and what to do. Right now, you now know what to do. So if you have any question, please, we have short 5 minutes. It's like, let me call it a break question time. 5 minutes. Let you just answer that before we go into the part B, which take about roughly about another 20 minutes. Then we can now go to general question.
I see a message from Nike saying I cannot go for a mortgage now. That's a very good question, Nike. It depends on your situation. The purpose of today is to educate you on what the criterias are. Wait to see the second part of the presentation. There are other solutions that are out there. The goal of today is to educate you so that you understand what it takes to qualify, so that you can start building the blocks. And so whenever anybody is ready, we can build those one-on-one sessions to look at your specific situations and say, okay, this is where you are today. This is what you need to do in order to be able to qualify to get to where you want to go. The question isn't whether if you can buy. The question is when and how. That's the purpose of today, is to allow you to understand that, and then you will be the one at the driving seat being able to determine that for yourself.
Somebody asked, so when is the best time to buy the mortgage?
Very good question. So when you talk to a real estate agent, their sales agents, they'll say, now, buy now. Everything, it's whenever you talk to them, they will always say, now is the time to buy. In reality, it really comes down to income assessment, debt ratio assessment, down payment accumulation. Once you have all of those criterias figured out and you are ready there, then at that point you look at the market and you have a very clear idea of how much you can afford. Then it's a matter of looking at, okay, well, do I wait for the season patterns to change? Am I ready to buy now and enter the market? What is the purpose of the purchase? Are you buying to live for yourself, or are you buying to purchase an investment property to rent out? Those are completely different questions that have different end results. So timing the market is not necessarily the case in some cases. In other cases, it is a valid factor. Ultimately, at the end of the day, it comes down to budget. If you can afford to purchase and you're able to invest, when you're looking at the market right now, to give everybody a bit of a quick background on Bank of Canada. Bank of Canada began raising interest rates in 2022 because inflation was at an all-time high for many reasons. One, the government had given a lot of money to individuals, to Canadians in 2020 and 2021 because of COVID. Number two, the government was sending a lot of money overseas to Ukraine for the war effort. Number three, the Canadian dollar is tied to the US dollar, to the US Treasury, like this. As a result, if something impacts the United States, it immediately amplifies and impacts the Canadian dollar. As a result of this, when the United States decided to sanction Russia in March of 2022, the second they sanctioned Russia, that had a negative consequence, causing inflation in the first world countries to go up. Why? Because Russia is a global power producer of oil and gas, one of the top 3 producers in the world, where they process and distribute to the Asian and South Asian market and the European market directly and indirectly. When you sanction a country that is a power producer of economy like that, it has a negative consequence in the United States, which has a negative consequence in UK, Canada, Australia, so on. That's why our inflation went up to 10%. As a result of that, Bank of Canada had no choice but to increase interest rates high to bring spending and cash circulation down in order to reduce the erosion of the Canadian dollar. By raising the rates so fast, so quick in 2022, leading into 2023, interest rates caused the price of properties to drop. So the best time to buy was actually 2 years ago because property prices fell 25, 30% like that within the year 2022. Having said that, interest rates remained high all of 2023 leading into the beginning of this year. So the second time to buy a property at the best negotiating power was before the summer of this year. Now we're going through a change. Now inflation has come down below 2%. This is what Bank of Canada requires. The central bank of any top world country requires inflation to be around 2% for 6 consecutive months. Once they have established that trend of keeping inflation at a baseline of 2% for 6 months, they begin lowering interest rate. And so Bank of Canada began doing that June of this year, July of this year, September of this year, and then most notably recently, October of this year. However, 2 weeks ago, new inflation data came out. Inflation went from 1.6% to 2%. Inflation went back up. Why? Because the government announced that they're going to send $50 billion to Ukraine. Trudeau announced his carbon tax initiative in April. The government in April also announced a $2 billion initiative for the housing economy to pay builders to build more houses. They are reducing the amount of immigrants coming into this country. And the biggest one, notably, Trump was elected, and he is now pushing the concept that he will be putting 25% tariff tax on any Canadian product going into the United States. This is going to cause a destabilization to Canadian companies, for example, wood, lumber, steel mill, any of the oil that goes down south that is generated in Alberta, even down to the mines that we have, the nickel and copper mines that get processed and sent down to the States for processing. All of these products are going to create a destabilized economy because of the high expensive tariffs. What that will do is it'll cause businesses to consolidate, shrink, possibly let go of staff. As unemployment goes up, this is going to create issues in Canada, possibly lead to a potential recession. As a result of this, from the beginning of October, before the election, the fixed interest rates actually began to go up. And so to answer that question earlier, when is the best time to buy? The reality of the situation is you can't time the market because the market is influenced by politics. It's influenced by oil and gas, GDP. There's a lot of factors. The question you have to ask yourself is, what is the investment that you're looking to do? As of right now, as interest rates begin to go back down in 2025, 2026, because you have 250 billion renewals coming in next year and up to 400 billion renewals coming in 2026, the Bank of Canada is stuck. They have no choice. You have all these Canadians that bought properties 2019, 2020, and 2021 at low interest rates of 1.5%, 2.5%. Now, when they're renewing their mortgage, they're renewing from 2.5% and they're jumping up to 6% or 5%. That's a big jump. That's a big hit to your cash flow. If you're working one job, now you need a second job. As a result of this, they have no choice but to create a soft landing. And so that's why the Bank of Canada started lowering the rates June of this year. They will continue lowering them up until the end of 2026 because they have to create a cushion or a pillow for people who are renewing to fall onto so that they don't lose their houses. As a result, over time, rates will come down by next year. When that happens, affordability goes up. And on top of that, I already told you that they're removing the stress test for anybody renewing on a renewal mortgage when they're switching from one bank to another. So with all of these policy initiatives that are coming in, it's going to create competition in the market, more demand to buy properties. And so a good time to get assessed is between now and March. And a good time to enter the market is anytime from spring to fall of next year. The earlier you get in, you still have some room to negotiate to bring the price down. However, if more buyers come out into the market because the interest rate has gone down quite significantly, in that situation, with that more competition, prices of homes will slowly begin to go back up again. So this is a cycle, goes up and down, and it's a long-term cycle of 10 years. We're now at a point where interest rates are on the roller coaster coming down. As demand picks up, prices will go up. So getting into the market relatively soon could be a wise idea. However, you want to buy something that's always within your budget because you have to pay the mortgage, property tax, condo fee, heating cost, utilities. You still have to do grocery shopping. You still have to feed your kids. You still have to pay your taxes. You still have to pay for your gas for your car. As a result, you want to purchase something within your budget whenever you're comfortable and ready and available to make that investment when you qualify. Once you start building the equity, that equity will build over time. Real estate is not quick. Real estate is a long game, and it's a very strategic game. The second half of our conversation, presentation, we'll talk about investments very soon, and we'll talk about different styles of investments very soon.
Oh, Thomas, thank you. I just wanted to say 1, 2 questions, and we can go to the part B because of time. I know a lot of people also.
I do notice here. So for Rabiatu, I want to buy a rental property. Will the rental income be taken into account? Yes, we will talk about that in my next half of the presentation. And yes, the rental income will be added to the income on application.
Okay, awesome. Then Casey, thank you so much, Thomas. Question 1, he said, how does one qualify for virtual banks since the interest rate is low? Maybe you can quickly just mention some point on that.
Very good question. So for virtual banks, credit unions, and the commercial banks, the measurement criteria is the same. It is established by Canada Mortgage Housing Corporation. The only difference is that the debt ratio assessment is locked in at 39.44. So the qualification measurement criteria is the same. All the banks will look at income the same way, credit the same way, down payment the same way. And so if you qualify with TD, you will qualify with the virtual bank. The only difference is how much you qualify. With the credit union and virtual bank, they will lower it a bit because of the 39 and 44 debt ratio. If you're putting 20% down payment or more and you're going to a commercial bank like Scotiabank, they will allow more debt on application. They will, instead of 350, they can allow 375 or 400,000 because the individual bank's policies are taking into consideration because they have the risk appetite for that. When it comes to the virtual bank, the measurement is the exact same. So if you qualify with one bank, you'll qualify for almost the same amount with the other.
Okay.
Next, the credit card. So having 2 credit cards,
having 2 credit cards, not using one, is there any negative impact?
No negative impact. It's if you close a credit card, and you only had the 2, it may lower your credit score for 2-3 months. If you keep using the other credit card, the score will go back up. What we need to understand is that Equifax and TransUnion, they feed from credit reporting agencies. So they can only determine your credit score based on the way you manage and pay your debt. It doesn't mean you should take on more debt. It just means that when you're buying groceries, just use your credit card to pay the groceries and then immediately pay it off that week or wait for the statement and make the payment. So it won't have a negative consequence as long as you frequently use it. Another way to trick the system is after using that credit card or line of credit for some period of time and your income is strong, go back to the credit card company, go back to the line of credit, go back to the bank, ask them to increase the limit. By increasing the limit and keeping your utilization low, this actually tricks the AI algorithm, and over time, your credit score goes up faster. Why? Because by increasing your credit limit, you're basically saying that I have this much capacity to get debt, but I'm only using this much, and I'm always paying on time. As a result, the algorithm will recognize that, and they will recognize that, wow, they manage their payments well. As a result of that, your credit score within 2-3 months will shoot up very quickly. What is the insurance rate with 5% down payment to insure? Very good question. The cost of insurance is on a sliding scale. As you put more down payment, the cost of insurance reduces. The cost of insurance is the highest at 5% down payment. And that cost of insurance is 4% of the mortgage volume. And so as you increase your down payment to 10% down, then that 4% becomes 3%. And if you increase your down payment to 19.99%, that cost of insurance goes down to 2% of the mortgage balance. It is automatically calculated by the bank's application system, and then it gets added to the mortgage. Which is better between condo, townhouse? Very good question. I actually have an exact scenario for this with real life case study with photos, and when we're looking at the investment portion of the conversation. It actually depends on your investment profile, but also your budget. People have a tendency to gravitate towards townhouses because there's no condo fee. I have both. I have a condo rental that's doing very well. I have a duplex that's doing very well. I also have another condo that I'm about to buy. It comes down to your investment strategy. Some people will only look at townhouses. My opinion is once you're at a stage, you have to start with a building block. If you can only afford a condo, get it. Get the condo within the budget and make sure it cash flows. We'll talk about this today. Once you have that for a little bit, you liquidate that, take that cash, and you scale up. Most people have a tendency to buy townhouses or single properties right away. But for the same price of a townhouse or condo, don't buy those. Buy a duplex or a triplex. And if it's not in the city of Ottawa, go a little bit outside to Arnprior or Carleton Place. It's better for you to collect rent from 2 units than 1. The problem with townhouses is in 2020, at the beginning of 2020, before COVID, townhouse prices were around $275,000 on the low end to $400,000 on the high end. Now, townhouses are $650,000 to $720,000. That's a significant jump. And the rent has only gone up marginally. So your cash flow is tight on a townhouse, which is why if you're buying something for $650,000, $700,000, you're better off taking that same amount of money, going to Carleton Place or Arnprior, where $650,000, $700,000 will get you a decent duplex, possibly a triplex, with 2 or 3 sources of rental income. And now you're not stuck with 1 rent. Now you have 3 rents, 3 different sources of rent. And so if one person doesn't pay, that's okay. You still have 2 more that are paying you. Your rent is still 1. You still have a static payment on the entire property, right? So it's actually better to buy a multi-unit property, take advantage of the tax credit that the government is already offering you, and be able to get cash flow positive very quickly, sit on the property for 5 years, let that property appreciate, because they will appreciate faster than townhouses. It's an investment purchase that's cash flowing positive. Let that property value up, take the equity out, and buy another multi-unit. That's the strategy that borrowers should start thinking about in the future. We'll talk more about that soon.
Okay, last question, so that we can go to the part B. How many years interval for mortgage renewal?
Very good question. Oftentimes, borrowers are made to believe by the banks. I want to preface something. I want to say that the bank is in the business of taking your money. So they want to hold you for as long as possible. But in reality, you have rights as a borrower. All banks offer 1 year, 2 year, 3 year, 4 year, 5 year, 7 year, and 10-year mortgages. You have to look at, on a case-by-case basis, what is the best strategy for your situation. Right now, it makes no sense to take a 5-year or a 4-year mortgage when within the next 2.5, 3 years, the rates are going to be half of what they are today. Therefore, it is wise to take a 3-year mortgage at the lowest rate that you can find, as long as you can qualify, and then renew sooner so that you can renew into a lower rate at a better cash flow, at a lower interest rate. However, when you look at the bank's marketing and pricing strategy, they give the best interest rates for the 5-year mortgage. And so when the borrower is looking at the interest rate, they're like, oh, wow, 4.1%. Why would I pay 5% for 3 years when I can pay 4.19 or 4.2%? This is where they catch you. They're giving you a carrot as a gift. Today, you think that 4.2% is a cheap rate. It's not. 5% is the cheaper rate in the long term, because within 3 years, you're going to go from 5% to 2.5% or 2.9%. Whatever the case may be, you'll pay a little bit more now for a short 3 years, but in the long term, you'll save even more and have more money in your pocket. Whereas if you did take the 4.2%, on an average, sure, you might save money for the first year, but by next year, the rates are going to be close to 4%, if not high threes. By 2026, the rates will be low threes. By 2027, the rates will be mid twos. And so you would have lost that opportunity and of that rate decrease. And for the other 2-3 years past that amount, you're now in the low twos. And if you are in the low twos, if the market is offering low twos and you're still paying 4.2, you're paying double the amount of interest. And if you try to cancel that mortgage, now you're stuck, because now you have to pay prepayment penalties. We're not going to talk about those today because that's a very long conversation, but suffice to say, for the time being, short-term mortgage is the way to go. For now, fixed is smart. By next year, it will be wise to start thinking about variable rates, because fixed has to stay high to fight inflation, because the government of Canada is continuing to spend money. We also have Canadian elections coming in next year. We have to be very careful of that. If Trudeau loses and loses power, the Conservative government most likely will come in. Whether they're minor or major doesn't matter. Conservative government usually have conservative policies, and they tend to bring costs down. And so that could potentially lead into a recession or not. So by next year, variable will be the way to go, because they have to keep the fixed rates high to fight inflation.
Wow, that's interesting. Please, let's take one more, and that's all for now for this part. For the first home buyer, must the partner buy jointly, or they are allowed to buy individually if qualified?
That's a very good question, Ms. Faluke. So you're absolutely right. If the individual is able to qualify on their own merit based on the income and down payment, no problem. If they have the down payment in their own account, no problem. If the other partner has some of the down payment, that's still okay, but the bank will want to see the bank statements of the partner as well. Now, having said that, if you are purchasing the property as a matrimonial home, that's no problem. It happens all the time. Sometimes you have one partner that earns the income. The other partner maybe is going to earn income later. Maybe they want to save for strategy. They want to save the first-time home buyer status and use it on another property. What's important to note is that if you're a married individual purchasing a property and living in that property, that first-time home buyer credit is applicable to both parties because they're married. It's a matrimonial home. And so if that other partner who wasn't on title in the first property tries to buy another property, you will not be eligible for the first-time home buyer tax credit of $4,000 in Ontario. Unfortunately, that's gone. But the strategy to perhaps not buy together is employed by individuals that have strong enough income to buy properties on their own merit, because they want to buy more properties in a rental portfolio. And as you buy more properties in your portfolio, previous property debts have to be factored in. Meaning, if you have one property and you're buying another one, well, the mortgage, the property tax, the condo fee, the heating cost of the property that you already own, or the properties that you already own, have to also be factored into the next purchase under the GDS and TDS ratios for the liabilities. And so if you have an individual that is putting some properties under their name and then you have another in their name, but they're living in the same house, well, the beauty is that if they're not on the application with the other person, well, then those debts are not going to that application. So as long as they can qualify, no problem.
Thank you. We have to stop the question right now because a lot of people will start being questioned and coming in. So keep your question till after the presentation. So Gomez, can you go into the part?
Absolutely. I wanted to double check there because this was a good question. You're recording the webinar, correct?
Yes, we are recording.
Wonderful. So for Ben Collins, all you have to do is just contact Adishola and he'll make the webinar available to you. And then for Miss Victoria, that is actually a good question. I will answer that. The FHSA is only available for first-time home buyers. Once you use it for your first-time home, FHSA, the RRSP, and the my apologies, the FHSA first-time home buyers, as well as the RSP, are only to be used as a first-time home buyer. Once you have used it, that's it. You're no longer allowed to use, unless you have sold the property, you no longer have any properties for 4 years. Once the 4th year is finished, you are now legally considered a first-time home buyer again. And so sometimes this happens where people used to own properties, say they sold a property in 2015, 2016. They were divorced, and so now they're living on their own. More than 4 years has elapsed. And so under the new definition with the federal government, you are allowed to get the FHSA and the RRSP as a first-time home buyer because you meet that threshold. If you own any properties during that period of time, you do not qualify for those products. Okay, so I'll go into part B. Okay, so now the conversation will lead into the other type of banks. A banks have the most strictest criteria to qualify. However, you do have B lenders, alternative lenders, and private lenders. There are many different types that are out there. To give you an example of who the B lenders are, the B lenders are your virtual banks. So First National, Equitable, CMLS, RFA, these banks have multiple departments. If your application conforms to the A lender guidelines, perfect, you'll get the best interest rate with this type of bank. If your file does not conform to A lender criteria, perhaps you have a delinquency in payments, perhaps your credit score is too low, perhaps your income does not qualify because you're a corporate owner and you're not declaring enough income on application because your personal income is too low, because you leave most of your revenues in your corporation because you don't want to pay a high personal tax. Well, the A lenders can only use your personal income. They cannot use your business income. B lenders, alternative lenders, and private lenders have more flexibility. It is important to note that the further right you go, if you go B lender to alternative, alternative to private, the interest rates begin to go up. The further right you go, they tend to charge application fees. B lenders charge 1% application fee as a one-time part of your closing cost. Alternative banks charge 1 to 2%, and the private banks charge a little bit more, anywhere between 2% to 4%, depending on the risk profile, depending on the credit score of the person. The B lenders can be a permanent solution, or they could be a band-aid solution. They're all federally regulated. It depends on the context of the individual. I'm going to use myself as an example. My properties are actually with the B banks, mainly because I refuse to show more income to CRA. Why would I want to pay $25,000, $30,000 in personal income tax when I can save that money within my corporation, use that as a down payment to buy a property? And so sometimes people want the best rate, but sometimes the best rate isn't the strategy. Sometimes buying the best priced property is the strategy. And in the long term, the interest rates will go down. The interest rate on a rental property is an expense. Therefore, you can still offset that from your gross revenues. And so if you've done the budgeting properly, it doesn't matter if you go to a B bank or alternative bank. It's about the portfolio, making sure the portfolio cash flows. Having said that, sometimes B lenders are a great solution for a short term because the individual was on a contract income. They don't qualify yet to go to the A bank, but the B bank will allow them to use that income. In that scenario, they go to the B bank for 1 year, 2 year, or 3 years. They declare more income, or they get the 2-year average of the T4s, and then they refinance and they go back to the A bank. The interest rate difference between an A bank and B bank is not a lot. Usually it's around 1%. I'll give you an example. If you have 20% down payment and you're going to an A bank, your interest rate today, right now, can be anywhere between a 4.34% to a 4.89%, depending on the bank. With the B bank, the same individual with the same property with 20% down payment the interest rate is anywhere between a 5.45 to a 5.24, depending on if they take a 1-year, 2-year, or 3-year mortgage. If they take a 1-year mortgage, the rate is a little bit higher. If they take a 2-year mortgage, the rate reduces. If they take a 3-year mortgage, the rate is even lower. It depends on how long it will take for the individual to correct or fix their issue, whether it's an income issue, credit issue, maybe perhaps they have too many properties or too much debt on application. So B lenders have flexibility for that. The further right you go, the more expensive it becomes. Alternative lenders and private banks, they don't necessarily look at income too much. They look at cash flow. They want to make sure that the value of the property is strong. They want to make sure that the property is well situated so that they're equity based. If the property location makes sense and there's enough down payment on the property and you have decent credit, or if you have bad credit, they sometimes don't care. What they care about is, do you have the cash flow? I have a client, his credit score is 497. He will never get any approval from A, B, or alternative. He has 5 rental properties and 2 commercial properties, all with private banks. Why? Because he has understood that he personally does not want to declare his cash flow to the CRA. And when COVID came in, he went to Money Mart, Cash Money, these type of banks to get cash to pay his employees. As a result of going to those type of institutions, his credit score went down. And so he was still able to buy properties, but at a high rate of 10, 12% interest rate. But he was putting in 35% down payment. All of that money he was cleaning from his businesses because his businesses were cash transactions. As a result, he has 2 mechanic shops with cash transactions. He uses that money and then he puts that money into his bank account and uses that to buy properties. The consequence is he has high interest rate, but the plus size is his portfolio is now worth almost $2.5 million. And so the properties have appreciated, and slowly now his credit score is finally starting to go up. By next year, I'm waiting for his credit score to be 550 so that I can actually take some of his properties from the private side, refinance it, and bring it to the B bank. The minimum cutoff with the B bank is 500 as a credit score. And so going back to the presentation, when it comes to the B bank, if an A bank is unable to do the situation for you, the B banks have some flexibility. Their debt service scores allowable are higher. They can go 50 to 50. In some cases, they can go a little bit higher to 60. What this means in simple terms is they can allow you to have more leverage or debt. In some cases, it doesn't mean that you have credit card or line of credit debt. It just means that you have too many properties. Or it just means that maybe you're a cosign on your brother or sister's property. As a result, your application is showing a lot of debt, but in reality, you're not paying that debt. Your sister is on her property, but you decided to cosign. As a result, your buying power is lower, which is why those individuals still can go to the B side, purchase what they need to purchase. It is important to note that to access B banks, alternative banks, and private banks, you absolutely need to have a minimum of 20% down payment. And the reason is because they are equity-based lenders. They don't deal with insurance at all. B banks will charge a 1% application fee based on the volume of mortgage. If your mortgage amount is $350,000, they will charge $3,500, which is 1%, at the time of closing. And so when you're budgeting for your closing cost of 2 to 2.5%, add 1 more percent to that so that it's 3 to 3.5%. And when your lawyer sends you the bill and tells you to bring the check, you have to pay that cost. The higher the mortgage, obviously the higher the cost. This is the cost of doing the transaction in terms of their fees. As a broker, I do not charge anything for A or B lending. Some brokers do. They nominally charge 0.5 to 1% as well. But in reality, the banks do compensate us, albeit not a lot. But in my particular case at Ottawa Mortgage Services, when I met Abhishek, I told him very clearly, I don't charge for those services at all. When it comes to B lenders, you're not able to go to commercial banks or credit unions, but the B lenders are the virtual banks. They just have different departments. And the most minimum credit score you need to access in order to access them is 500. Interest rates vary depending on the credit score. If your credit score is higher, 680 or more, you'll have a lower interest rate. If your credit score is lower, the risk is higher, therefore the interest rate will be higher. B lenders are an option for those that are denied by the A banks looking for more flexibility. So they cater to individuals who may not meet the stringent A lender guidelines. Perhaps they've missed payments on their credit bureau. Perhaps they have not enough income history, or, and this is a big one, maybe their income is earned outside of Canada. I have had clients that earn income in China. I had one client who earned income in Rwanda. Guaranteed income. I have the bank statements that prove from Rwanda or from China that they are getting deposits every single month for the last 12 months. Unfortunately, A banks do not consider that as a source of income. It's not declared to CRA in Canada. However, with B banks, they are flexible. They say, show us your bank statements for the last 12 months. Let us take a look at the calculations, and we will be able to use that as a source of income on application, because they're looking at cash flow. Perhaps you're self-employed and you're not able to qualify based on what you personally declare to CRA, like me. I don't declare as much to CRA. Why would I want to pay $25,000 in tax when I can save that, take that money out and buy a property tax efficiently? And so for people like me, we're stuck. And so if I'm not prepared to pay to CRA a higher tax for 2 years in order to qualify to go to an A bank, then I'm stuck with the B bank. Perhaps the purchasing property price is too high. Perhaps there are too many properties and their debt ratios are high. Perhaps, as I mentioned, that income is generated outside of Canada. Some key points about B lenders, again, they're less stringent in their criteria. They're lenient with the credit score. If your score is lower than the A lender required, you're still required a good chance of securing the mortgage. And then for those that are discharging a bankruptcy or a consumer proposal, A lenders will not touch you anywhere between 4 to 6 years. B lenders will, as long as we are able to provide proof of what happened and why it happened. If in some cases, they may ask you to pay the bankruptcy. In some cases, they may ask you to pay the consumer proposal. In some cases, they may say, don't worry about it. As long as you can demonstrate you're making those payments on time and your credit score is now starting to go up, they will allow you to get the mortgage. Whereas an A bank will not touch you for a good 5-6 years after the consumer proposal is paid off. And so sometimes some individuals are stuck for 8-9 years before they can ever go back to an A bank. Flexible income verifications for self-employed individuals, commission individuals like lawyers, real estate agents, people with irregular income, or people that are hiding their income. Maybe, you own a pizza shop, you have some cash coming in and you're not always showing that cash or declaring it on your personal income tax or business tax. So B lenders can use alternative ways to verify income, such as your bank statements. The higher level of interest, usually 1% more, they can be used for short-term solutions or long-term, depending on what the situation is of the individual. If you are an individual like me, personally, I will probably permanently stay with the B bank only because for tax efficiencies, I pay 10 to 12% corporate tax on the net amount left over after all expenses. Why would I want to pay 25-30% personal tax and lose more money to CRA? And so if I'm losing 20 to 30,000 per year by declaring more income versus paying an extra 3,000 per year on interest, I personally would rather pay the extra 3,000 per year than lose 20,000 to personal income tax. This is not the case for everyone. Some individuals, especially those with credit issues, they're on a fixed income. So they're not looking to have tax efficiencies like me. So for them, they should stay with the B bank short term and try to get back to an A bank as soon as possible. It's not the same for everyone, right? It's a case-by-case basis. We have to determine that strategy with your accountant, with your lawyer, and with your financial planner, so that we understand what is the best case scenario for you globally. Does it make sense to declare tax or not? Very simple case study scenario. This is a real scenario that is actually happening right now for a client. The names have been changed. Taylor and Noah want to purchase a home. Taylor is self-employed consultant with 1 year of self-employed business. She only declared $30,000 worth of income last year because she started halfway through the year. Her corporation this year made $100,000 and she only declared $50K in expenses. So that means she still has $50K left in the business. However, she took out $30K out of the $50K to pay herself personally. And so she got taxed personally on the $30,000 personally, and then corporate tax, she still has $20,000 left as retained earnings. She got taxed 10% on that $20K. A banks don't care about any of this. What they care about is, well, how much did she declare this year? $30K? Well, does she have a 2-year average? She doesn't. Oh, I can't help you. Why? Because the A bank, they know the tax loopholes. They know business owners can play with the tax strategies to declare whatever they want. As a result, the A banks need a 2-year history to qualify the individual. I'm going to this level in depth mainly because there are some people here on our call today that are business individuals or individuals with interest of going into business. And so this is a rather important topic. Her husband, on the other hand, Noah, works full-time, high-tech, earning $60K salary. So with an A bank, we can only use Noah's income of $60K. Taylor's income, we would need the following documents with an A bank. We would need 2 years of T4, 2 years of notice of assessment, 2 years of T1 general personal income tax filing, 2 years of T2 corporate income filing to confirm that she actually has money in the corporation to still pay herself, the articles of incorporation to confirm that her corporation is legitimate and legal and not a fraud. In addition to that, the accountant's notice to reader with 2-year financial statements prepared by the accountant. So just to qualify with an A bank, for a guy like me, I'm like Taylor here, why would I want to wait 2 years and give them all of these documents and then still pay $20,000, $30,000 in personal income tax just so that I can get a 1% discount? And I still have to wait until 2027 to qualify. And the property price would have gone up maybe 10, 15% by then. So it will take 2.5 years, if not 3 years, for Taylor to properly qualify with an A bank. If she starts today, she will be ready to purchase in 2027 with an A bank. That is so foolish. It's foolish because, on the other hand, with the B bank, for the same scenario, we only need to show 6 months to 12 months of bank statement history to show the net operating business income, meaning you have gross revenues being deposited, we subtract the expenses, and then we add the fake expenses back into the income. As a business owner, you have legitimate expenses like your cell phone, your rent, and then you have flexible expenses that Adishola and Olubukanola can talk to you about that you can add as expense that the government will allow you. And so in reality, on paper, you're showing more expenses to reduce your corporate tax. But in reality, the B bank recognizes that that is not a real expense. That's okay. Let's add it back to your income. And so in reality, she paid herself $30,000, and out of the money that's left over in her account, she could add that back in. And so instead of $30K on application, we can use $50 to $60K on application, depending on the calculations of the bank statements. And so now on the application with the B bank, we're using up to $110,000 on application. That is a big difference in terms of buying power. And so by going to the B lender with interest rates declining in 2024 to 2026, buying demand is expected to return and increase. As demand increases, the property value and prices will begin to increase as buyers can begin to afford properties again. If Noah and Taylor wait to qualify in 2027, they will get a lower rate, but it's foolish because they will end up losing out on the opportunity to buy a property at a competitive pricing based on today's pricing right now, while the values are still quote unquote lower. As the interest rates decline, the property values will go up because demand will go up because interest rates are coming down. So if they wait for 2 years, they'll buy the same property, but at a higher price, at a higher mortgage volume. Even if the interest rate is lower, their total payment obligation will be higher with the A bank, and they'll be paying the same amount that they could have been paying the B bank at a lower price. And so let's put this into numbers. Some people are scared, oh, A bank is charging more. Let's actually look at the numbers. A lender scenario, purchase price 400,000, down payment, say 20% at 80K, closing cost is 10,000 at 2%. With an A bank, let's say the monthly payment is 4.79%. Therefore, the monthly payment is $1,667 per month. And so if they qualify today, this is what they're getting with an A bank. If they didn't qualify with an A bank, but were prepared to go with a B bank with 20% down payment for the same property, same purchase price, same down payment, the closing cost would be a little bit higher because you are paying the application fee of 1% to the B bank. The monthly mortgage payment, say hypothetically right now, is 5.49, which it is for a 1-year rate. The monthly payment would be $1,802. That's a difference of $134 a month. This translates to $3,231 over a 24-month span. If we increase down payment by down payment to 100K instead of 80K, then that's 25% down. This lowers the payment from $1,802 to $1,689. So the numbers are really relative at the end of the day. $134 a month extra is really not that big of a deal, especially if you're buying a property negotiated at a good price, because the same property could be $450,000, $500,000 within the next 2 years when you are ready and able to qualify. And so again, as long as you have 20% down payment, these type of options can be available to you. I'm just going to skip this because we talked about this already. Very quickly, I will glaze over this. Alternative lenders and mortgage investment corporations, they require 20% down payment. As I mentioned, their application fee is 2 to 3%. There's a variety of different types that are out there: Magenta, BrightPath, Riverrock. These type of banks are a bandage solution used for a variety of reasons. If you're doing renovations, you're doing construction, you need bridge loans, you need short-term mortgage solutions, these are the banks to go. They're equity-based lenders, minimum 20 to 25% down payment. Credit score, 500 or more. In some cases, they don't even care about the credit score if you have a high enough down payment, if you have a decent amount of cash flow that you can show by bank statements. Interest rates vary based on loan to value. The higher the down payment, the lower the interest rate for them. Private lenders or private mortgage lenders come into play when both A and B lenders are not a viable option. These lenders are individuals or private companies willing to take on the higher risk. High flexibility in terms of overlooking financial details. Some individuals, like my client who doesn't show a lot of income to CRA or cash flow, will buy properties with the private bank as a strategy. And then that interest rate he writes off as a business expense on all of his properties. They are high interest rates, significantly higher than the B banks, anywhere between 7 to 12%, depending on depending on the credit score and depending on the amount of down payment or loan to value. Often they're only short-term solutions, 6 months, 1 year, 2 year. They're normally interest only. And so although the interest payment is high, there's no principal being paid. And so people will buy properties, especially contractors, builders, property investors. They will, if they find a quick investment that is a very good buy, it's a distressed sale, the seller needs to sell the property, and they're able to negotiate the price down by 15%, let's say. Well, then they'll go to the private bank, very quickly buy the property. Within 2-3 weeks, they can have the property, and then they can take the time to refinance and go back to a B bank or an A bank. And so that a lot of the times that is the case, where the investor is buying the property quickly to close on the property, to take advantage of the property, and then take possession, perhaps do rehabilitation, perhaps get the contractor, electrician, plumber in there to fix the property very quickly. And then within 6 months to 1 year, they'll flip the property for a profit and sell it. All of the interest is an expense that is written off from the gross profit that is made out of the sale, and which means that they end up paying less tax on the flipping of the property. So a lot of strategic planning is required in order to be able to transition out of the private mortgage lender. It's only to be used as a bandage solution. My advice is the following. Because there's a lot of bad reputation that is out there with brokers and bank agents that misuse private banks and private individuals, which creates a fear within the market. When it comes to B lenders, alternative lenders, and private lenders, it's like a knife. A knife is a tool. You can use it to cut steak, or you can use it to hurt somebody. Ultimately, the policy is the policy. It is not meant to be used or abused. But unfortunately, from 2020 till within this year, until the federal government changed a lot of their policies for private mortgages, they're clamping down on that because there's been a lot of fraud, a lot of misuse, and a lot of hurt that has been done by individuals going to private banks. Private banks haven't done it. It's just that they have been mishandled by these individuals, mainly because when prices of houses were cheap in 2020, interest rates were dirt cheap, people were...
Okay, fine.
Oh, sorry, Vera, could you put yourself on mute?
Let me find.
Adishola, could you put Vera on mute?
I repeat your mama thing on the floor. Take it.
Hi, Vera, could you put yourself on mute?
So tell me, you shouldn't paddle phone.
Adishola, are you able to check the audio settings and put everybody else on mute?
Are you okay?
Adishola, you're on mute.
I'm trying to figure out that.
Click on click on Vera's icon, and click on Vera's icon,
Okay.
and uncheck where it says allow participants to unmute themselves.
Okay. Okay, go ahead.
Thank you. Sorry about that, everyone.
Yeah, sorry about that.
We are near completion. As I move forward from all lenders, we're going to do 2 case study scenarios for investments, and then after that, we'll go into questions. I'll just skip forward here. Investment buyers. Okay, so this is the final topic of the day. I have Excel sheets that are created to show you real scenarios with real people that purchased actual investment properties. We will look at cash flow assessments in order to determine what it takes to actually assess a property. And so investment buyers, creating a long-term wealth through investments and ownership. You want to think about diversifying your portfolio from cash, stocks, bonds, and real estate. Creating a pension plan for the future, especially if you're self-employed and if you're not using RRSPs or TFSAs. Like the client that I have with a low credit score, that individual has a portfolio of $2.5 million already, and he's buying more properties. That individual is using real estate for his pension retirement, because at one point these mortgages will be paid off by the tenants, and then he'll be able to put lines of credit to be able to take advantage of cash flow and supplement his income using that, or selling properties in order to get that liquid cash. So investing now for yourself or for your children's future. finding an investment property that meets your risk and return. So there have been questions about whether I should buy now or not. It's not about when you buy, it's about can you qualify to buy? Because once you are able to qualify to buy and you have the vision, then you have to do risk assessment and business planning. And so as an investment buyer, you have to look at the market. I have mentioned already from an investment perspective, 2020 to 2022 was not the best time to buy. The best time to sell, sorry, was in 2020 to 2021 to take advantage of the low interest rates and the multiple offers that were happening on properties. As I mentioned, townhouses went from 400,000 to 700,000. And so if somebody did sell one or two townhouses in that period of time for 700, now they're sitting on $1.4 million in cash. And so then those people that understand this real estate game are patient. They sell when it's the right time to sell, and then they wait until the interest rates go up. When the rest of the market is panicking and selling their properties, that's when they buy, because they have the cash, they've been patient, and they're waiting for the property to get to a point where it's distressed so that they can come in and make an even lower offer, purchase the property, rehab it, add another unit or two, and then from there put it into the market for rent or sell it. I'm of the opinion that real estate land in Canada is becoming more and more scarce over time. And so land is finite. For example, bungalows in Ottawa, if they were built in 1940 to 1975, they were built on large land, 6,000 square feet, 8,000 square feet, 10,000 square feet. If you look at bungalows today, for those that are being built after, say, 2002, the land size has reduced over time. Could be the same footprint of the bungalow, but the backyard and the front yard is now being reduced. And that's because we're headed into a densification. As more people come into Canada, the government of Canada, the municipality, city of Ottawa, as an example, are looking to densify and pack people into that small space. And so that large space of land is becoming more and more scarce. As a result, I'm of the opinion that if you are able to buy a property within your budget and it can cash flow and that nothing comes out of your pocket, buy it. Because that property, if you bought it for $400,000 today, within 8-10 years, $900,000. Imagine this: townhouses in Toronto were being sold in 2000 to 2005 around 250,000. Now townhouses in Toronto are going for 1.1 million. Imagine if you had just bought one of those and you kept it and you rented it out. Now you're sitting on $1 million portfolio with just one property, right? So it's foolish to buy a townhouse today because the prices are too high. It's wiser to buy multiple units. But all of that to say that those that already have the portfolio, it's wiser to keep it if it's the right location with the right functionality, with the right maintenance on the property. So finding an investment property that meets your risk and return portfolio, securing the financing, A, B, alternative and private, finding good tenants that will pay you as a landlord. The rental income should cover all of the costs of the property. For example, the ultimate goal is to increase the value of the property in the long term and take advantage of that equity. And the rent in itself is a profit, but it's not, it's just cash flow. If you're making even $100 a month profit, that's better than losing $100 and paying out of pocket, because in the long term, that property value will go up fast. And when it does, you can take advantage of liquidating that property, taking the equity out when the interest rate is back down to 2.25%, and then take that extra cash and reinvest it into another property, or start creating a corporation and partnering up with your cousin or another business venture partner to create a portfolio. And so as a result, location is very key for any type of investment or even for retail investment. Convenient location, desirable to the renter. You're buying a property, you're in the business of renting it out to a tenant. The tenant is your consumer. So you have to think about who is your consumer. So I own a bakery, and in my bakery, I have it located in Hintonburg. So I have to think about who is my consumer coming in for their coffee and baked goods. Same thing for a property. What is my target demographic? Am I buying properties near the university and targeting students? Am I looking for student income? Or am I looking to buy a duplex or triplex and having it located in Barrhaven, Canada, or Stittsville in high market areas, looking for young professionals and renting it out to them? So location is key, and understanding the tenant is key, so that can determine where you want to buy and what your business strategy is. You ideally want to buy in low crime areas, good school districts to attract good tenants that are paying tenants that will not miss a payment, near shopping malls, near public transport, near hospitals, because you want to make it convenient for your tenant to have access to amenities. You want to have also, from a budget, minimum of 4 months reserve set on the side as a contingency for any unexpected repairs that could happen on the property. And anything can happen. Air conditioner could go bust. Perhaps your furnace needs a replacement, or just annual maintenance by replacing the filters. You need to have money set aside as a reserve fund to maintain your property. If you maintain your property and the tenant sees you maintaining that property, they will respect you and respect the property, thereby keeping the longevity of that property's life longer. You want to invest in that. I see landlords from time to time that just want to buy a property and rent it out as quickly as possible without thinking about taking care of their property. And this becomes a problem, because if they don't demonstrate a pride of ownership, they're going to attract the wrong type of tenant who could potentially not make their payments. If the landlord doesn't care to fix that faucet or bathroom, why should I pay the landlord? It creates friction. You want to make it easier for the tenant in order for them to pay you your monthly payment. So considering all expenses when you're budgeting, mortgage payment, property tax, if you're using a property management firm, condominium fees, insurance costs, repairs and maintenance, 4% vacancy, you will not always have a tenant. On one of my rental properties, my tenant moved out in November. I had it vacant all the way up until February. I could have rented it out in December or January, but I was patient. I was intentionally patient because the tenants that come in December, January are individuals that may or may not pay the most optimal rent, because landlords who rent out properties during the winter period, December and January, tend to be desperate because they want somebody in there right away to pay their mortgages, to pay their property taxes. But if you have a reserve, you can be patient so that by spring, when new tenants come in and there's more people in the market, you can rent out the property at a higher price the way it should be. And then it limits the bad crowd, and it allows you to pick and choose the tenant that you want, because there's a large pool of tenants. Use professionals as much as possible when you are building your portfolio. This includes accountants, real estate agents, appraisers, home inspectors, mortgage broker, lawyer, property manager, electrician, contractor. You're now in the business of purchasing, maintaining a property for the purposes of renting. So you need to know all of those things, and you need to learn and educate yourself on all of that. Do I buy the property under my name, or do I buy it in a corporation? Okay, I need to talk to an accountant and lawyer about that. I need to talk to the broker to find out, will the bank allow me to buy it under a holding company? Who will allow me to buy it? Is there a change in interest rate because I'm buying it in a corporation? What are the measurement criteria with the bank to allow me to buy it under a holding company? So those are the things that you have to investigate and learn from all of these individuals so that you're ready to enter the market. If you don't do this, and I have met many clients that don't do this, they end up having 4 or 5 properties all under their name. And then the banks tell them, I can't give you a loan because you have too many properties, too much debt under your name. Scotia says no, BMO says no, TD says no, RBC says no. They come to me, and then I take them to the B side. The B side, yes, we will do it, because their policies are different. They can allow up to 20 properties with some banks. And so then the question is, well, was it the most optimal structure the way that they did it? No. After the first property, they should have incorporated. They should have put the properties in there, because all it takes is one tenant to have an accident in the house. If the property is not in a corporation, they can sue you directly instead of suing the corporation. In Canada, a corporation is legally a separate entity. And so if you're purchasing an asset within that corporation, then at the very least, you are insulated for any type of liability that is incurred within that corporation. Now, if you're providing a personal guarantee, it could still come back to you. But from an insurance point of view, you are still able to create that blanket buffer between you and that entity and the asset. And so there's many factors that we can get into. That's a conversation for another day. All of that to say that those are the things you have to think about. Before we conclude, I want to take the time to show you real deals on how you assess investment properties. And so I'm going to share my screen here and switch over to a scenario. This is a real client that I am working with. It's the same process with any client, because it comes down to a business assessment. It's very different than buying your own personal property. This particular client, husband and wife, they are elderly. Wife is still working, husband is retired, and they have poor credit. It's okay, but not the best. They don't qualify with an A bank. They were able to sell properties back home in Congo. They brought that money into Canada. That is about $140,000. And right now they are renting in a townhouse for $1,200. They have been renting for the last about 12 years or so at a low rent. And so they came to me and they said, okay, well, should we buy a property to move into, or should we buy a property to invest? It is important to note that the wife is an actual PSW and the husband is a retired accountant, but he has no income. And he was an accountant back home in Congo, not in Canada. And so he has no pension in Canada. They did have land, which they sold and brought the money here in Canada. So they were asking, what is the best way to invest that money? And so after sitting down with them and reviewing their portfolio, financial situation, credit situation, so on and so forth, I presented them two scenarios. I said, okay, if you want to live in the property, you could purchase a condo where almost 50% of your down payment can go into the condo, and your monthly expenses are very minimal, because you're putting in 50% down payment on a $300,000 property. Your mortgage payment will be less than $1,000 a month, plus condo fee, plus utilities, etc. And so with the income that the wife is earning, they could actually get by no problem and still be okay. The other option is to buy a multi-unit, duplex or triplex, let the tenants in the other units pay the mortgage property tax and live in the unit for free. And so he said, okay, can you do me a favor? Can you look at all of the condos available in the market? Can you also look at all of the duplex or triplexes available in the market in the greater Ottawa area? And can you build me a scenario of what is the best way to go? I said, no problem. This is a very tough ask in terms of timeline. It will take me a lot of time to assess, but yes, I will build that for you. And so I started working with the real estate agent, and I asked the real estate agent to inspect the market and send me the MLS listings for all of the condos that are available in the market that are up to $350,000 as a price, knowing that we can negotiate some of these down to $300,000 or even lower, $280,000, $270,000, depending on location. And the idea was to try to find a condo where the condo fee covers utilities. It covers the heat, hydro, water, sewer, and that the only other item that the tenant the owner has to pay is the property tax. And so the idea was that if they wanted to rent it out to a family, they could still rent it out with $150,000 down payment. They could still rent out the property for $2,000 to $2,200, but their mortgage payment obligations would be very low. Or they can move into it if they wanted to take advantage of the low payments. It's entirely up to them. I also asked that real estate agent, can you canvass the market and send me a report of all of the duplexes, triplexes, and fourplexes that are available up to 600 to 650,000 in purchase price? I had already done the assessment on their file, and I knew the break-even points on the numbers very well. So they could buy 700, 750, but then they're paying. Chances are they're paying money out of pocket. And so I wanted to create a scenario where they're walking away with money in their pocket, not paying anything out of their pocket. And so when you do this enough times, you learn what those numbers are. And so that's this listing here. The first listing we're looking at is the condo. I'm not going to go through 29 pages. Neither are you. The real estate agent gave me 29 pages. What did I do? The first measurement that you do as an investor is to assess the debt ratio right off the bat for the return on investment. And so you look at what is the list price. You divide that by the total annual income possible. So it's purchase price divided by annual income. And so I did that for every single property. And when you do the ratios, I put the number here. So I did 327,000 divided by 24,000 of rent per year, which is 2,000 per month. That gave me a factor of 13. I looked at the next property. 289,000 divided by 24,000 gives me a factor of 12. I did that for the next property, gave me a factor of 16. I did that for the next property, gave me a factor of 15. I did that for every single property without even looking at the details. I only looked at the price and I looked at the rent. Then I went through all of the numbers, 13, 12, 16, so on and so forth, and I picked out properties that were below 15. There is a general rule of thumb in real estate investment. When you are assessing return on investment for properties, if the factor of price to rent ratio is less than 15, generally you have a decent investment. The lower the number, the better the return. What you will realize when you do this exercise over and over and over again in 2023, 2024, 2025, what I have come to realize, and you will realize the same, the factors usually stop in Ottawa around 12. And you have to go outside of the city of Ottawa, where the prices are a little bit lower, to get maybe a factor of 11. But sometimes going outside of the city isn't the best smart idea. And so a factor of 12 to 15 is smart. I then took that and I started looking at each individual property with the listings. And what you're looking for is you're looking at the year of build. You are looking at the condo fee, the property tax. You're looking at where is the location, what is the rent for that location, how old is the property. You look at the photos online of the property, and you try to assess, does this make sense for the investor to buy this property based on location, age, finishings, did the seller do updates or not, so on and so forth. Once you have all of that metric data, you build this Excel sheet. Adishola, are you guys able to see the sheet?
Yes.
Wonderful, thank you. So on this Excel sheet here, out of the 29 properties, we were able to funnel down 6 properties that actually make sense for an investment for the condos. And so here now we start to cash flow assess the properties with realistic, actual, tangible numbers that are actually being paid by the seller. So the purchase price is listed, the down payment of the client is provided, the interest rate is provided. It is important to note that for this particular client, their interest rate was not the best, mainly because A, the husband has no income, and B, they had credit issues. The wife, who does have the income, her credit score was below 600. As a result, based on her credit rating, the interest rate was a little bit higher. As a result, the monthly mortgage payment is higher. That's okay. Who cares if the interest rate is higher? The goal is to find a property that works with those ratios. And so we put in all of the expenses, condo fees, property tax, insurance, water, heater, electricity. It is important to note that more often than not, And if any of you are renting, you probably know this. Usually the tenant pays for water, heat, electricity. They're paying for their own utility cost. I told the investor, I don't care if the tenant is paying the utilities or not. I want to do an assessment. If you have to pay everything because there's no tenant in there, can you still walk away? And so when I did these total costs, I factored in all of the expenses, everything. And then I talked to the real estate agent per property and I said, tell me, what is not the highest income? What is the lowest income that we can get away with? If we were to rent it out tomorrow in December, what is the rent that I can list to guarantee me a tenant within 1 week? I need a tenant right away. What is the lowest rent? And all business owners want to look at the optimal return or the best return. I am a man of numbers. I want to look at the worst case scenario. If it doesn't cash flow at a high rate, and if it doesn't cash flow in the middle of December, that is not the right property. We need to find a property that makes sense at the worst case scenario. And so he gave me the rental numbers. As a result, out of the 6 that are here, one was a negative cash flow. This one, $316 a month in positive surplus profit, 155, 74, 251 in profit. And then this one, $388 a month in profit. This is after paying the condo fee, after paying the insurance, after paying the property tax, the utilities. As a result, if the condo fee includes the water, heat, and electricity, the landlord is not paying for that. The tenant is already paying $2,100. And so if I was to remove those from the calculation, the actual cash flow return is $688 for that property. And so now if I remove that for this property as well, the actual cash flow return in reality is actually $616. And so when you do it that way, okay, wow, they're walking away with $7,000 in profit annually just by buying one of these 2 properties. And so somebody earlier in our chat asked, should I buy a condo or a townhouse? Buy what you can afford based on the budget, because the proof is in the numbers that are here in front of you. Now, this is a condo. Let's change gears and look at multi-units. So I'm going to go back to the listing and show you some properties. Here we have in Arnprior a 4-plex, 650,000. So it's not a 350,000 purchase, it's double, almost double, 650. Rent here being collected is 51,000 annually. Expenses are about 15,000 annually. And so I didn't put the numbers here because I had done the work already, and there's over 23 sheets, but effectively I did the same thing. I went through every single sheet and I looked at the price and I looked at the income. I divided the price of the house by the annual income, and that gave me the factor. As long as the factor was below 15, I then looked at the actual listing. I read the listing. I looked at the year of the build. I looked at the rent. I looked at the expenses. And then based off of that, I added it to the Excel sheet or not. And then once we did that for every single property, when we go back to the Excel sheet, for all of the multi-units, out of the 23 properties, we were able to come up with 10 properties. So I want you to notice something here. Out of the 29 properties for the condos, I was only able to find 6. And out of the 6, 1 actually ended up being a bad investment with a negative cash flow. However, with the multi-units, we have a lot more options. Why? Because there are multiple rental incomes coming from one property. Most of them are duplexes. A couple are triplex and fourplexes. And so now the game begins. Now we put the purchase price of all the properties. We put the down payment of all the properties based on what the client can put. Minimum 20% is the requirement. Mortgage balance, depending on what the down payment is. Monthly mortgage payment. Remember, this individual had an interest rate of 7% because of the poor credit score. And so now the challenge is, will I find a property that will positively cash flow because their interest rate is higher because of the credit score? And so I went back to the real estate agent and I said, okay, same thing. Tell me the worst rent that I can get out of this triplex, out of this duplex, out of this triplex. So he sent me a list, all of the listings with their potential rents that was already, so some of the information was already on the listing. And then sometimes the tenants move out. And so the properties are vacant. If the properties are vacant, then because we have more than one unit, maybe one unit, the rent is low, but because the other unit has a vacancy, we can charge market rent at a higher rent. So then it balances out the total cash flow coming from the property. So I did that with the real estate agent per property. And so we were able to get the rental income. I want you to notice here, 4,500, 3,000, 4,500, 4,200, 2,600. Compare that to the condos, 2,200, 2,000, 1,800, so on and so forth. So here the condo is a one unit generating you this much. Here you have the multiple units giving you a higher cash flow. Just because you have a higher cash flow doesn't mean that you could actually, just because you have higher rent doesn't mean that you can cash flow. Here you could have $4,200 a month in rent, but your actual expenses are $4,200 as well. So depending on the property and depending on the actual expenses that the seller is incurring based on property tax, insurance, water, heater, heat, utility cost, we then go through the assessment. Keeping in mind, I said this before as well, I don't care if the tenant is paying the utilities. What I care about is if the landlord has to pay the utilities, what is the actual cost to the landlord? And so a lot of these numbers are negative intentionally, and they shouldn't be. And in reality, they wouldn't be. But I wanted to find the best properties. And so in this scenario here, out of the 10 properties, 2 stood out. One for $500 a month, one for $439 a month. Now, if I remove the expenses that the tenant will pay and only factor in the property tax, insurance, because the utility cost is paid by the tenants, this property in reality is actually generating $1,050 a month in profit. This property is generating $1,048 on the dot. And so here they're yielding almost the exact amount. And so now, if that's the case, then I have to look at, well, what is the cost of the utilities? So I go back and I add the debts back in. And so in reality, this property, out of the 23 properties that are available in the market as multi-units, ends up being the property as an investor. And it took us a month and a half to get this. Why? Because we had to be patient. Multiple units don't come in the market all the time. And so some properties stay in the market a lot longer than others. And so the client was willing to be patient. And so if you're seeing a lot of negative numbers, then I tell the client, just be patient. There will come a property that's a distressed sale. Why buy for $650 when you can buy at lower price for $570 at the highest return? Can you imagine all these other properties, $650, $640, yet this one at $570 with these amount of expenses, being a triplex, gave the highest return to the client. And this is the same client who's paying 7% interest. Imagine if his interest rate was 4%, his profit would be even higher. And so this is the method and the process in trying to determine what is the best investment for properties, whether it's a condo, townhouse, single property, duplex, triplex, etc. I have one last scenario. It's not going to take too long. We're going to look at another Excel sheet. The reason why I want to show this to you is because this is a another way to calculate the investments. It's not enough to find the property and do all of that. That's the first step. Once you have done that, then we have to evaluate the mortgage process, the mortgage interest rates. And so for the same, for a different individual, we did the same assessment at the beginning of last year. Out of there was, I think, about like 15 or 20 properties that were available at the time. We were only able to identify 3 properties that actually made sense. But I want you to look at down here, this tab. I started off at 10%. And then I created a scenario for 8%. Then I created a scenario for 6.5, 5.34. Why did I do this? This is the private lender rate. This is the alternative bank rate. This is the B lender rate. And then this is the A lender rate. We did this because if the buyer, who is an investor, was in a situation where they find a property, it's in distress, it needs to be purchased immediately to minimize any type of competition from future buyers, then we want to stress the property at a higher rate, at a rate which, if they did happen to buy with a private bank, like my client who has 5 properties with the private lenders, well, will the property still cash flow? Even if it's $100 in profit per month, will it cash flow? And so out of the 15 properties that were available at that time, we stressed it at 10% interest rate. We put in all of the expenses of the properties that were available on the listing sheet. We put in the rental income that we were able to determine with the real estate agent, and then we were able to determine the cash flow. And so at the 10% mark, 262 John Street was the property. Then we do it at 8%, 6%, and then 5%. By the time I did the 5%, we found another property, 209, 213 Prescott in Smiths Falls. And this was a triplex. And so we ended up doing the cash flow assessment on all of the properties. And we were able to find the 2 that I mentioned, one John Street and one Prescott. John Street at the A lender rate was cash flowing at $1,000 a month, the other one at $870. And by the time the client was about to make an offer, somebody bought John Street. And the other properties didn't make sense cash flow wise, because this one here at $550 a month in profit, the location was too far, Pembroke. Prescott is in Smith Falls. It was closer to the landlord, closer to the buyer. And so they not only was it closer, but it was also a better profit. So we ended up making an offer on this one, and they actually got this property. When they purchased this property, then we had to look at the interest rate. And to answer one of the questions earlier, I did say, 3-year rate is the better way to go. When you're looking at business cash flow, you have to look at long term as well. And so I told the client, listen, let's look at the budget, 3 years, 4 years, and 5 years based on the interest rate. Let's look at the fixed, let's look at the variable. And so now we're going a deeper dive and looking at the cash flow assessment based on the differing interest rates. And so in the end, yes, 5-year rate is lower. She's making more money, but in reality, it's smarter for her to take the 3 years. And this was in around April of this year, of 2024. And at that time, the rates were higher, and she was still making a profit. In about 2.5 years, the rates are going to be almost say 2.5%, 3%. She's already making a profit of $800. In the future, she'll make an even more profit, more than $1,000, because of the fact that the mortgage rates are going to decline over time. And so this gives you a sample of another method of how to calculate interest rates based on the mortgage policies. And so finally, why use a mortgage broker? If anything you've learned in the last 2.5 hours is this, that knowledge is power. Mortgage policies are not accessible necessarily online. You've learned a lot today, a lot more than you thought you knew. And these policies vary from lender to lender. A good broker with an entrepreneurial mindset and business mindset can understand the value of customer service, cash flow, budgeting, risk analysis, needs assessment, and then help you build your goals and objectives to whatever it is that you want. It's not about if you can buy, it's about how and when. Access to all lending solutions, A, B, alternative, private, Through the brokers, you have access to negotiating power. When it comes to credit analysis, credit history, we only pull the credit bureau once. We don't pull it multiple times, like as if you're shopping for a car. If you're doing car financing, the car brokers, they end up pulling the credit every time they have to send it to a company. In our case, we pull it once, and then when the file is ready to be submitted, we submit the credit bureau with the application, so the bank doesn't repull twice, and so your credit rating stays intact. Working with the broker is of no cost to you if we're going with an A bank, B bank, or alternative. If we have to go to a private bank or a mortgage investment corporation for whatever reason, in that case, we have to charge at the very most 1%. Some brokers charge more. The reason is because the private banks do not pay the brokers at all. And this is a lot of work that you've seen already. This takes time to develop. And so at that point, we negotiate that price with the buyer. Other than that, A lending, B lending, and alternative lending, we do not charge. At the end of the day, personal attention to detail, independence, and objectivity. You are not a transaction. You are not a number. You are a human being who is looking to enrich yourself and the lives of your family. That's the reason why you're here today. That's the reason why you reached out to Adishola. We work with you based on your needs, your goals, and your vision. We educate you on the policies that pertain to your specific circumstances. I've said this many times before. Everybody wants the best rate. It's not about the rate. If anything, today you've learned the world is beyond just the rate. The rate is just a small aspect. It's everything else that goes with it that determines whether you can get approved or not, or if it's the best strategy. In some cases, the rate can be higher, but the strategy can give you a better return. In other cases, the strategy is the lower rate. So it's on a case-by-case basis. And so then it's up to you to decide what you want to do. Our role is just to educate and help you along the way in your journey. That concludes our presentation for today. I know this was a very long presentation. Wow. If you have any questions, you can take note of my email. If you want a copy of this PowerPoint, Adishola has a copy of this already. Feel free to email him as well, and he can forward this to you along with the webinar from today. My number is noted there as well. It's a direct number. There's no secretary. If I don't get to it right away, I will call you or text you. My wife just gave birth about a week ago with a new baby, so bear with me when it comes to timelines, but I always check my emails and telephone very frequently throughout the day, including even now, I've been checking my messages. I will open the floor to questions.
Wow. Thank you, Gamas. Thank you. I said it. I said, you must know, if you miss anything, don't miss this, and it was so, I tell you, I remember that I went for a course just to learn some of the things that you taught, and I know how much they charged me. So I can imagine you got this for free. So please, if you're here, thank you so much. It took us a long time, right? This is almost 3 hours on the call, but it's value for money. This is the training that you're going to go for and you're going to pay, and they're still going to waste your time. They won't give any information, and it does dash it out. Dash it out. You understand? So thank you so much for taking your time to educate us. I must confess, I've learned a lot. So before I engage any question, I want to there's also if you want to put a call directly with Gamas, there's a link that's shared on the chat. Please click on the link. Your phone number, your email, your name is going to go directly to him, and you can also book a call directly with him one-on-one. You understand? So it also has phone number here. Please, I want everybody. If you want to go into investment, for us right now, we are considering investments, and we know what we're gonna do. So we're not going for mortgage. Some people, their first thing is mortgage. Some people it's investment. So whichever category you fall into, please get in touch with him, and he's going to be ready to help you. He's our friend. As a matter of fact, he's one of the best friends I have in Canada. If anything happens to me right now, he's the first person that I will know. So Gomez is a very good friend to the family. My kids talk about him all the time because when I go to the store, they get more pastries and all that. They want, are you going to your friend? And so he's a very good friend. He's a very, very good friend. So please book a call with him. It's not necessary that you you're not getting a mortgage next year. Some people, I'm not getting next year in 6 months. I'm not getting 1 year. It doesn't matter. Gomez engaged us for almost 3 years before we got our mortgage. 3 years. And we were with him, telling us what to do, not to do, what to do, what not to do, what to do. Was like a coaching, teaching us every line by line. So it's not necessary, oh, I'm not ready in 1 year, or I'm not ready in 2 years. It doesn't matter. If you engage him, he could tutor you to know what you need, and you can start preparing for it. You know, if you don't know what you want to prepare for, even when you're ready, you might not even qualify for it because you're not prepared. So the first thing is for you to prepare yourself, engage him, know what you need, and start preparing for it. So I put in the link, the phone number is there. Then also, if you want the slide, I also put my email, 2000@gmail. If you want the slide, it's also giving us a slide free. Please, thank you to Gomez. It's also one, so please, that's my email. Please just send me an email that you want the slide, and I will gladly forward the slide to you, because he said that we should forward to everybody. Wow, this is a powerful slide that everybody should have. Please, I've sent in my email. Just send me a mail that you want the slide, and I will send the slide to you. So please.
Which chat are you sending this to, sir? I can't see them. I'm sorry. I have to comment.
You know what?
I'm looking the chats. I've been looking through the chat. Maybe before you go off, sir.
Yeah.
I can't see the details. I don't know whether I'm looking at the wrong chat.
You see, I'm looking at the chat right now.
The email wasn't there. I think you have to click on meeting group chat.
Okay, sorry. Maybe something went wrong there.
It might have gone to one person directly.
Okay. So let me see, meeting group chat. Okay, so let me repeat that again. Sorry, maybe something went wrong there. Let me pick this. Okay, sorry about that.
There was a question asking if I do mortgages across Canada. Yes, so as a licensed broker here in Ontario, through the brokerage that I'm licensed under with the province, have lending desks that allow us to access across Canada. The only province that we're not able to get licensing in is Northwest Territories. I have done mortgages up north very seldomly. I don't do them that often, and it's mainly directly with the banks directly, the top 5 banks, BMO in particular. Not a lot of lending solutions are in Northwest Territories for a variety of different reasons. So I tend to not take those deals unless it's a referral from a friend and the individual stuck, and if I can help, then I'll try to help. As for the rest of the provinces, our role and goal is to help educate. The policies that we discussed are federally regulated policies. It doesn't matter what province you go to, the policy will stay the same because they're regulated. What will change is the type of lenders that are there. So for example, credit unions or B lenders, depending on the province. For example, if you're in the province of Quebec, they have a very limited space for B lenders. There's no alternative banks, and they have a large pool of private banks. And so that has to do with the regulations, the restrictions, and the policies that are in place by the province of Quebec for lending institutions. As a result of that, we end up being restricted on the diversity of possibilities of banks that are in specific provinces, Quebec being one of them, Newfoundland being another one, the East Coast territories, they, depending on location, depending on the property value, if it's A lending, no problem, they operate in all provinces in terms of commercial banks. But if it's B lending or private lending, then it's a case-by-case basis depending on the province. So our role is to help walk you through that path and figure out what type of solution you need at that point. There was also a question I note here, when doing an investment purchase while taking the time to analyze the data, do you keep in touch with the sellers to make sure the house is still on sale, the market or the real estate agent do that with you? Very good question. This is where the team comes in. And so when you are in the process of interviewing an accountant, a broker, lawyer, real estate agent is one of the individuals on your team that you want. They have access to all of the metric data that is not available on just Google. When you go to realtor.ca or House Sigma or Redfin, they will give you the data that's available generally in the market at a surface level. The real information, the price of what it was originally bought, the price that it was listed, the price that it was delisted and relisted, the time from the time it was originally listed to when it was sold, what was it sold for, to who it was sold. All of that data can only be retrieved by the real estate agents because they have the license with their brokerages on all of those transactions. And then once you have that data with the real estate agent, you can start mapping out that information. If you're looking at duplexes or triplexes in a specific geolocation, and you have the data of properties that were sold over the last 3 to 5 months of that type, then you have a general pattern of what the comparables are for that type of property. With your real estate agent, then you're able to create a strategy on what is your offer going to be on a similar property if it becomes available for sale in the market. Very good question.
Wow, Gomez, thank you so much. I do appreciate. I think with what I'm thinking, maybe we'll have to still invite you again, but this time around it's just for investment, people that are interested in going to investing and all that. Then we're going to come again and so talk about investing. So it's going to be purely investing. So, and the tutorial are going to be more investing and people that are ready to go into investment. So which province is best to buy?
That's a very good question. It again comes down to budget. In terms of lending solutions, Ontario for sure, and British Columbia. You have to look at the economy of that province and the cities that you're looking to invest. You have to look at the growth of the population, the type of industries, the services. For example, if you were purchasing a property in Alberta 10 years ago when the oil industry was doing well, that was a booming place. Now, after the fires and after the issues that we've had with the oil and gas industry in Alberta, Alberta prices are low. People are purchasing there, but industry has to be there to be able to offer services to people to work, right? So the prices at one point will stagnate in a place like Alberta for now. Calgary is booming, Edmonton is booming. It will take time. So if you have extra investment cash, it could be wise to invest as a long-term hold in a place like Alberta or Nova Scotia or New Brunswick. These areas are aggressively growing. You have to be very mindful of each province's limitation on taxation and land transfer tax. If you are purchasing to invest, some of these provinces like Nova Scotia, Prince Edward Island, New Brunswick have extra taxation that you have to consider for non-resident buyers. So sometimes you might be able to get a good deal in a province or in a particular city, but then you may have added costs to worry about as well. But if it's a long-term hold in an area that is a long-term growth market, then you're not making money right away, nor are you seeing the appreciation immediately. But it could be in the case of like the townhouse in Ottawa that went from 350, 400,000 to now 700,000. That's the kind of growth you could see in the long term. In the short term, you're better off looking at areas that are already developed or slightly outside of that catchment area of densification. For example, if your budget can allow you to purchase as an example, let's take Ottawa for the case study. If you buy within the city of Ottawa, I would advise you to buy on the west side, Canada, Barrhaven, Stittsville, Richmond. These are growth markets, higher socioeconomic return. This is where you have to look at the market census for the geolocations to see where is the income, where are they deriving their income? Are these government employees, tech employees? What is the average household income in that area? What are the amenities? Look at the crime stats. What is the propensity of crime within that catchment area? From there, once you've tabulated all of that, compare that to other parts of that city. And then you'll realize, okay, well, this is the area I want to invest in. What are the rent potentials? What are the prices? Generally speaking, higher socioeconomic status areas will have higher priced properties with also higher return in terms of rent. It's a double-edged sword because maybe you're financially not capable of buying that type of property there. So then it could be wise to find a subpar property in a rich area, meaning maybe the property is a bit too old and it's being sold at a lower price, but it is in Canada in the high tech sector. That's a place to invest because the socioeconomic status of that area is higher, crime rates are lower. Generally, people that are renting in that area are working nearby. They have higher income of 160,000 to 200,000 per household. They can afford to pay the high rent. And so then you buy the property at a lower price in the rich neighborhood or affluent neighborhood, and then you rehab that property. You get extra money, you improve the bathroom, the kitchen, you make the minor renovations to make it look good cosmetically, and then you rent it out. So it depends on the location. In the long term, you have to look at the real estate agents, the lawyers, and the accountants to look at what is your actual portfolio. If you're looking for multi-unit investments, bigger cities is the way to go, or emerging markets like Kingston is an emerging market. Outside of the Greater Toronto area, like Barrie, Oakville, the Scarborough, Perth area, Smith Falls, Carleton Place, Arnprior, Rockland is an emerging area. These are where the population is expanding out east, west, and south. And so over time, you're going to see growth. Those that can't afford to live in the city will start to move out. And that's just very natural. Look at Toronto. 15 years ago, Toronto was smaller. Look at where Toronto is today. You have Mississauga and Scarborough and Brampton. Property prices for townhouses are now close to $1 million. You have to go really outside of the city to Port Hope and areas outside of Port Hope to get townhouses at $200,000 cheaper, right? So location is key, but it comes down to proximity for where you're living as well.
Well,
did I miss another question?
Guys, there's no question. So I've sent in the link. Please, everybody, click on the link and give us your email, your phone number. I also have access to that information from him. So that basically, if you anything you want a mortgage, you want anything on investment, and maybe if also for your mortgage you need an insurance, then we can also help you. Or you start a business and you think, oh, you want an accountant for your taxes, please, we can also have access to it. We'll get back to you on that. Please click on that information. Give us your email, give us your phone number. We'll get back to you. And also, we have a community where we give first-hand information about what is happening. Like people in our community knows that it's coming, and they are most of them are here. So you also want to join that community. You can also I have my email, sholanyola2000@gmail.com. Put it there that you want to join the community, then we'll add you to that community. So you have first-hand information, and we are also adding Gomez to that community. So it's also part of our community. So it's going to give us more information too, from time to time, what to do. And we are still bringing him again. So it's only for the community members. And this basically more for investment. And it's just going to be for community members. So I have my email. Let me drop my email again. If you want to join the community, which Gomez is part of it, and it's going to, you can just send a mail to me that you want to join the community. We'll send the sholanyola2000@gmail.com. We'll add you to that community, to that WhatsApp group. We're going to add Gomez to that group too. It's going to give us more information, investment tips, what to look for. And that's what we are talking about here. We just want to develop a community where we can grow together. Information is key. This information he gave us now, he gave us like 3-4 years ago. So by now, it was easy for us to get a mortgage because we know what we wanted to do. And we thank him so much for that. So it's not about information, I don't have it or I don't have it. Sometimes information flies, people might decide to be somewhere else, but you are here. We spent over 3 hours just to gain this knowledge. And this knowledge is power, right? You don't get it anywhere. This is information that you go to get, to say pay $5,000 for this training, pay $7,000, and it gave it to us free, and I'm so much thank you for that. So please, I have my email. If you want to join the community, send an email to me. that you want to join the community, we'll add you to community. Gomez is going to be part of it. And if you want to book a one-on-one call with him to discuss more about your condition, your situation, please, you also have the link there. It's going to just put in your email, your phone number, and whatever information that you also need. We're also going to get back to you maybe on insurance, or you want an accounting service, or you want to set up a business. You know, we talk about company right now. There's no way in Canada that you want to grow or you want to become somebody that you must not set up an entity. You must. That's the way to go. You can see what he's saying. There's a way you can hide. That's true. You can hide under a corporation a little bit, do so many things. But for a self-employed, you can't, because the money is being taken out from source. But as an corporation, you first pay yourself first. Is the remaining that you then pay to the government. That's how it has been structured. That's why you see a lot of business owners don't pay much in taxes. And look at the rate a company pays compared to personal income tax. It's so much different. So there's a lot of opportunity when you have a company. So if you also need to set up a company, you don't know what to do, get back to us. Put in your email and phone number. We'll also call you. We'll know what is your concern. Then we will get back to you, and we'll know what you want, and we can give you an advice that suits your purpose. So if you still have any question, we want to get out of here for 8:30. If you have any other question, if you want us to unmute you, we can unmute you. If you want to give a good shout out to Gomez, this is 3.5 hours. My God, for somebody. So I know before we got him, it took a lot because he's so busy. He has just declined, and also he knew that it took him time to leave all that to give us that value. Please, please, I wanted to in the chat. I want to say, please put a thank you to him. Please on the chat, what you have learned. Please, can you put in the chat? It's not easy. You know how much money you would have. It's an opportunity cost, but it decided to give us the time for us to learn. It's not only buying mortgage, also taught us about investing. So which is also powerful. Please in the chat, you can a shout out to him. Thank you. What you have learned, you've learned so much. Please put it in the chat, and that is so. If you don't have any question, we want to wrap it up. If you have any question, put in our 8:30. We want to wrap it up, and if you want the slide, so I've sent you my email. Just send it to me so to know that you need the slide, and I'm going to forward the slide to you. If you want Gomez one-on-one discussion on mortgage, on investment, right now we are looking at more investment, so we know what to do. Please also, the link is there. Put in email if you want on insurance, accounting. We have one-stop shop, and Gomez is also one of our partners. You understand? We do insurance, we do accounting, we do financial planning, but he does more of the mortgage side. That is his own core, that is his own area. But if you're talking about insurance, accounting side, you come to us. So we have other real estate. We also have other team members to real estate, will, trust, and all that people that do all that. So it's a community. So if you join our community, you have one-stop community, investment, everything together. It's one package. So you know that anybody you're talking to is one community. So thank you, Gomez. And since we don't have any question, we need to appreciate you for bringing him first, and the new dad in the house. Thank you so much. I'm blessed and informed. Yes, Big Dream Global Network. Yes, Big Dad. A shout out to the new dad. No, we're gonna talk more about that later. Initial, even without time that you don't have, you still created that time. So thank you so much. Casey, please unmute yourself briefly. We want to get out 8:30. Please, you can unmute yourself and
yes.
Ask your question.
Thank you so much. Can you hear me?
Yeah, we can hear you.
Thank you so much, Gomez. Thank you, Adeshola. Thank you. I mean, always thank you. I think I should become a real estate agent now with this information. Anyway, thank you so much, Gomez. I really appreciate it. And I mean, Adeshola and the wife have also been helping us getting through these things. Just on the last page, the one you shared now, the Excel file, I just want to check the triplet. I see that the price for that, the one that's actually good for the greens, the price is 570 for each of them, which is both. But later on, the cash flow for one is more than the other. I actually want to know what makes the difference, what makes it go down for the other one. Is it the year of build?
Let me just double check.
I'm sorry to take you back anyway. Just
Oh no, that's okay. Was it the most recent one or the first Excel sheet?
The most recent one, the last one, the multi-unit.
The multi-unit. Yes. Okay. Yeah. Oh, right. And what was the reason for the cash flow to be higher on the lower priced property?
Yes, because the price is the same. It's 570 each, if I can still remember.
Yes. I'm going to share my screen and we're going to look at that all together. I believe this is the one you're referring to.
Yes, if you check the price, purchase price,
570 and 570. Yeah. And so then what is the difference between the two? So the difference, the mortgage amount is the same. The down payment is the same. The property taxes were the same because both of these are literally right next to each other. 6607 Fourth Line Road. This one is 6609 and 6613 Fourth Line Road. Both of these are in the county, although it's in Ottawa, it's outside of Ottawa in the county of North Gower. Both were triplexes. The varying differences were in the utility cost of heat and electricity. And so that little bit of a difference in this property gave it a better return compared to this one. They're on the same road. They're almost identical because they were built around the same time. They're both listed for the same price, but it was the utility cost that was better with one particular one, even though everything else was the same. Property tax was the same. Insurance was about the same as well. Both of them are being managed by the same property management firm. The utility cost difference has to do with the services that are being provided to that location. The size of the property was the same, but the difference was the maintenance that was being done on one of the properties. They had a newer water heater as well as a newer furnace. And so those energy efficiencies that were done on that property as a maintenance by the landlord allowed for that much of an efficiency. So let's actually compare the two. This is a very, very good question. Water is nominal here, but heat difference between $308 versus $241, electricity of $200 versus $116, just by changing and upgrading the appliances to energy efficient allowed for a better return. Now, mind you, at the end of the day, this calculation is based off of the utility usage and the property tax, but in reality, the tenants are the ones that are paying for this. Now, strategically, if this property is yielding a better utility return, then the tenants are going to be happy. You can have a wider gap of rental return. So if the property management firm was smart, they could actually say, well, the total cost of this utility on this property here. Sorry. So the total cost is $458 versus this one, which is $608. So that difference of $100 and some dollars a month could be translated into a higher rent return.
Yeah. That would be the same as this one. I mean, thank you so much, Guben. Thank you so much. I was just wondering why the price changes.
It's a very good question, and these are the minute things that we have to look at per property for assessments. The devil's in the details, and ultimately, at the end of the day, the cash flow assessment will end up giving you the truth clarity on whether you have a good property versus a scale property.
Awesome. Thank you. Yeah, that's all.
Thank you, Casey. Gomez, I want to quickly, my own question on that is that, we did that analysis. You didn't pay, what about the cost you pay to the property management in that costing? Because it's going to be paid by you. But looking at that costing, I didn't see the amount you're going to pay to the property management company there.
So very good question. The property management companies typically charge 8 to 10% of the gross revenues. Okay. So whatever the values that you saw for gross rent, just deduct 10% off of that. on a monthly basis, and that's the amount that you would typically budget and pay for. In those specific scenarios, the clients aren't using property management; they're going to self-manage the properties.
Okay.
So I didn't include it in there, but
Okay.
you are 100% correct. If you are electing to use a property management firm, then you can budget 8 to 10% off of the gross revenues
Okay.
as an expense on the
Okay.
property.
I got it. I got it. I got it. Okay, so thank you so much. Do you also know that if you want to go into investment, it don't necessarily, for people on this call, it doesn't necessarily that you have to put your money down. Like for example, 120,000. You can do it jointly. Maybe you have 2, 3 people, so you can set up an incorporation, and you guys can put money together and buy one. You can start with that. So that's why we are forming that community and to see how well we can start things together. These are community people have done somewhere before and they are now, big. So you don't need to find, I want to do a down payment. You want four trippers and you want to do it on your own. Or why can I get 120,000 or 150,000? It's something that 3 or 4 people can come together, form a company and go into it and get that down payment to buy one. And, and they can start with that. You understand? So this is why I said we still need Gomez to come back again, but really this is for investment purpose. And this is going to be people that are ready to go into investment and ready to do that. You understand? So it's just going to be purely investment. And if you're not ready for investment, you won't be part of that team. But for mortgage, yes, investment, please communicate. We are putting his link there. Please, everybody, your email, your phone number, put it there. If you want any services from us, it's going to forward those email and those lists to me too. We're going to get in touch with you, whatever you want. Please, we want to be like a community where we can serve you and we can serve you better, right? Accounting services, insurance, financial planning. These are the things that you want. And so watch out for the next webinar. It's going to come in. We're bringing somebody else in. And that's why I said you must be part of the community. We are bringing somebody that will come and talk about RSP. How do you use your RSP for private investment? You understand? There's a lot of private where you get rate 8%, 9%, 10%. We're also bringing someone in. So please join our community. The community is going to benefit more when we bring these people. And Gomez is coming again. So it's the people that join the community that will first get the first-hand information, while we then publicize it. And we're also planning, if you have, maybe you want Gomez you have a gathering of people that you want Gomez to come and share information with, please get in touch with him and he will gladly do that so let's just help each other to grow, basically. So without any question, Gomez, I want to say a big thank you to you for gracing this occasion and this event. And I want to say a big thank you for coming. I'm so happy. I'm so delighted. And, for those kind of information you gave us, it's like, I'm just going to buy my mortgage again, and, those information is key and information is power, right? So thank you for giving us those information. And we hope to see you some other time. And we're going to add you to our community where, you can drop us 1 or 2 information because the community has people that are ready to start their business, people that are ready to register their company, people that are ready to advance. That's why we created that community. So we're going to add you to that community where you give us some advice. I know you have a bakery, you have a lot of businesses around you, so maybe you give us 1 or 2 advice to kickstart and to help us. Maybe also bring you another day to come and talk about business, not on mortgage right now, maybe on just business. So we are calling people that intend to be a business owner. We'll bring them in and we're going to talk about more business. You understand? So if you want that, join the community and it's going to help us with that. So thank you, Gomez. So
Thank you. Thank you for having me.
We want to end this webinar. And thank you so much, everybody, for joining. And we took about 3.5 hours. That's a very long webinar. And everybody stayed. So we want to appreciate everybody taking your time to learn one of those things. And we appreciate you, everybody, from every part of Canada, from being part of us, to learn this. And we tell you, we are strong together. Don't let anybody tell you otherwise. You understand? Information is key. Information is power. Information can transform you. So thank you so much for taking your time to join us. Then we'll see you. Watch out for the next webinar. And if you also want to join the community, we'll also put in the email there. We'll add you to that community. You see, we've already been posting more information, and we're going to add Gomez too. We're going to see more information that's going to come in, and that will help us grow. So thank you so much, and we'll see you on the other side, and we'll see you. So thank you, and Gomez, I'm going to talk to you. Bye-bye. So everybody,
Thank you.
thank you so much for doing that webinar.
Thank you,
And you
guys.
can mute
Thank you.
yourself. You want to say anything?
Thank you. Bye.
Thank you.
Thank you, thank you,
Yeah.
thank you, thank you so much.
Thank you.
Thank you so
Nice to
much.
know you, Mr. Gomez.
Thank
I
you
mean,
so
this
much,
is wonderful.
Gomez. Oh
Thank
my
you so
God.
much.
Yes.
It's
Mr. Adesola, very good initiative.
so
Thank
you so much.
informative.
Thank you so
Oh my
much.
God, so detailed.
you.
Thank you.
Thank you, thank you.
Thank you,
God
guys.
bless
Thank
you.
you for coming. Thank you,
Thank you,
guys.
Gomez.
Thank you.
Regards to the baby
I
and
hope
the
to
mommy.
very soon. This,
Thank
Mr.
you, guys.
Bye-bye.
God bless the newborn. Bye.
Join our community. Join the community. Join. More is coming.
How do we join the community? Is it WhatsApp?
How do we
Yeah.
How
join?
do we
Yeah.
join
Just
community?
send a mail to me, sholanyola@gmail.com, and I will add you. We'll send you we request for your number, but it must be a Canadian number, and we'll
I'll-
add you to that community.
I'll
We'll
send-
make
Is it like a WhatsApp? Is it a WhatsApp group?
Yes, it's going to be a WhatsApp group for now.
Okay. I'll send you.
Whenever we'll have maybe a webinar will come in, everybody will come to a webinar like this.
Okay.
Yeah, but we already sent information to your wife. Well, that's why we joined this one.
Oh, okay. If you have
so
sent to my wife already and she has already added you, it's fine.
Yeah.
I'm talking to new people.
Okay, is it the same thing? Is it the same one that we have with your wife that you're calling the community?
Yes.
Okay, already there. I'm
Oh, you're
already
already there. Okay, fine. Oh, see, some people
Thank
already
you.
there already. So yes, I told you that some people that has the first-hand information are here.
Okay.
Yes.
Yeah.
So people that are not part of the community already, maybe they are just part of this
Yeah.
this webinar, should give us an email, and then at their
Yeah.
we'll have them. Then we'll grow together. That's the most. And
Yes.
Gomez
Sure.
has been somebody that I know for a time. He saw us grow.
Oh my God.
That way.
Yeah.
He saw me grow, and I'm so appreciative.
And the testimony you gave to speaks a lot. He said he kept you like 3 years.
He kept
informing you.
He held us together. Even let me tell you a story
Wow.
that we didn't say. Do you know when we started? And he told us to go to a mortgage, another what's it called? A real estate agent that he wanted us
Yes.
to. The real estate agent decided to, like, you know what? Let's remove Gomez. Let's do another transaction and let's do it.
Wow.
I said, I told my wife, even before my wife said anything, I said, you know what? I said, no. And that's why we called the guy off. I said, whatever we're doing,
Of course.
deal with Gomez. He said, no, Gomez, that's not what he's talking about. I said, no, we are clear from where we come from.
Yeah.
In Nigerian, we deal with somebody that integrity is key. I said, I'm not going to do that. And that's why we called it up. We're calling off and we're pushing him aside. And remember to give your friend that introduced to us said this.
Exactly.
So well, that was a part of the game. And he took it lightly.
Wow.
I look at him and said, well, Gomez,
so why do they want him aside? Why do they want him not there?
That's
they want to rip you off. That's why.
That's transaction for you.
Yeah.
So he said, and the funniest part when I told him, Gomez said, Shola, that's the part of the game. That's what happened. I said, you so simple. For me, I would have rained fire, but
I hope it won't send somebody else again down there.
No, that was about 3 years ago. That's about 3 years when the first time we decided to go for a mortgage. And just and the guy said, you know what? No, don't talk to our governments. We'll take it to another a mortgage agent that will do the transaction and they will get it right now. They bust the money that
but somebody sent you there.
And it was the one that sent us. I said, no, I don't understand.
Confusion.
You send us here to see you, and you want to
see you introduce us to
person.
Hey,
I said we are not doing that, basically, and that's what we did. And